Hello, my CMA Final friends. This is your ranker friend, CACS CMA Prasad Bhat, and I hope that you have taken help. You have been assisted by the MCQs we solved. You must have gone through that. We have also given a prediction about how the June 26 attempt is going to be. And first of all, I want to thank you for your good comments, your likes, your subscribes. So I'm grateful for that. Now let us continue our revision session. So today we are going to revise the concept of Forex. Okay, so this is what we are going to revise in today's sessions in very simple language. All the concepts of Forex we are going to revise, discuss, and then we'll also solve some exam questions at the end. Okay, so let us start our revision session. So first question is, what is the meaning of the word Forex? It stands for foreign exchange market. So popularly known as Forex. So what about the foreign exchange market? So foreign exchange market is a market where we are exchanging currencies. So in simple language, it is a foreign currency market. So what happens here is we exchange the currencies from one to the other one. Okay, so we exchange different currencies of the world. If we had a single currency for the entire world, then this topic would not be there in the syllabus. This topic would not be a problem at all if there was a same currency throughout every country in the world. But unfortunately, every country have their own currencies, and therefore as students and as professionals, we have to learn this topic. So the Forex market is the largest. It is the largest market in the world with respect to the turnover. The average turnover, okay, may go up to, on one fine day, it can go up to even USD 10 trillion per day. Okay, the turnover can go up to USD 10 trillion per day. So largest market in the world, more than any of the biggest stock exchanges. The world's top stock exchanges are New York Stock Exchange, London Stock Exchange, but this is way bigger than that. And the simple reason why it is so big, because it is a world market. It is a world market, and countries, so not just companies, not just small shareholders or big shareholders, countries are involved in this market. So if one country is trading with another country, one country is transferring its currency to another country, then obviously the transaction value is big. And that is why it is the largest, huge market in the world. Then this market runs 24/7. Now why do we say it runs 24/7? Because of the different time zones. So obviously if you consider from east to west, the Japanese market will start. So when the Japanese market starts, in India we are fast asleep. We are sleeping nicely. Then the Australian markets will start, and slowly, steadily, step by step, the Singapore markets will start. Then the rise of the Indian markets. Then we go then into the Middle East, that is the Dubai market. Then we go to European markets, the US market. So because of the time zones, the market is open 24/7. So 24 hours we can say. Okay, obviously on Sundays the market will be closed, but on Saturday again, because of time zones, there is some part of, means for example, if in India it is a Saturday morning, then in USA still they are working. Okay, so that way if you see, so it's a way of saying that it's a 24/7 market, but practically if you see 24 hours, yes, but not 7 days a week. You can say 5.5 days a week, but still the market goes on. Okay, then because it is an international market, because it is a market between countries and continents, okay, the market runs on an online basis. It runs on networks. So you will not find any a specific single place. So if you're talking of Bombay Stock Exchange, so we have a BSC building in Mumbai. Okay, in Dalal Street, BSC, South Bombay, you get down at CST station, correct, walk for 10-15 minutes, and then you have a huge building of the Bombay Stock Exchange. If you go to Mumbai itself, in BKC, you have a NSC building. So these are called as physical places. But if you consider a foreign exchange market, okay, there is no one single place or a building where this market happens, where this market operates. So we say that it is a online market. It is a virtual market. Okay, we can say it's a virtual market where transactions means millions and billions of dollars and rupees and euros and pounds. All these transactions happen, but through the online market. And because it's a market of involving money itself, so what are goods here? The goods itself is money, and therefore we also say that it is the most liquid market. It is the most liquid market for the simple reason that it is money versus money, money versus money. So it is a highly liquid market. Okay, and the market also, it's a pure, once we use the word market, then there is demand and supply, and therefore this market also is based on demand supply forces. We will see in some part that how the currencies fluctuate, but purely on demand and supply forces. So if a theory question is asked that, okay, what is explain what is a foreign exchange market, or what are the features of a foreign exchange market, then we have this in front of us, that these are the various features. So in our exam there is question number 8 which has this theory part. Plus in some MCQ, if they have to ask some theory question on forex, then they may ask from this part. Okay, then so as the market, as I said, it is a market based on time zones, and therefore the top markets here are the Tokyo market. As we come east, then we come to the Singapore market. Okay, as we go ahead, then we have the Dubai market, we have the London market, then there is Luxembourg in Europe, then there is the New York market. So these are the prime areas, you can say. Okay, not to forget, in Germany we have the Zurich and the Frankfurt market in Germany. So Germany also is a top place for international markets, international transactions. Okay, so Tokyo from the eastern side, and as we go towards the west, then USA, and then again from the other side, time zones, again we're back to Japan, that is Tokyo market. So different markets, different time zones, and few international markets which I have mentioned here. Then when we talk of a foreign exchange market, so foreign exchange market, the main role of foreign exchange market is exchange of currencies, and at the same time exchange of the foreign currency reserves, not just the currencies. When currencies change hands, then reserves also changes hands. And therefore, we say that the foreign exchange market helps in the change in purchasing power of every country, purchasing power of every economy. And how is the purchasing power of a country is measured in terms of international transactions? It is measured in terms of US dollar reserves. You may be aware that India faced a major currency crunch in the year 1991. You must have heard reports, or you must have read here and there, that the foreign currency reserves of India was not sufficient even for a month. That means in a matter of few days, India would have been declared, that is, bankrupt in terms of foreign currency. Whatever we had imports, okay, we did not have the money, the foreign currency to pay for those imports. And that is where we had to change our economic policy. We had to adopt our economic policy in 1991. And that gave rise to liberalization, privatization, globalization, LPG. Everybody knows this. But very few are aware that in 1991, our government also has taken an important step, that is devaluation of currency. That also happened in 1991, that is devaluation of the rupee by the action of the government of India. So what is the meaning of devaluation? It is to reduce the value of the Indian rupee with respect to the US dollar. And why did our country do that? So that the exports would be benefited and the imports would be restricted. Okay, the problem India was having is we did not have much foreign currency to pay for imports. And therefore, one of the steps is to reduce the imports. And that's why India devalued its domestic currency, that is rupee, to make it favorable for the exporters and adverse for the importers. So we did this last time was in 1991, devaluation of the Indian rupee. So when you talk of Indian currency with respect to foreign currency, then when I use the word exchange, that means there has to be an exchange rate. And this exchange rate, for example, right now I am just putting the current rates. So we are in the first week of June. So I'm just writing the approximate rates. Why approximate? Because by the time you see the video, the rates must have been changed. Okay, the rates change each and every day. So maybe you see the video after 2 days, then the rates will be different what I'm writing here. So what I'm writing here are the current rates. So for example, the current rate of dollar with respect to rupee is somewhere around 94.90. If you consider the euro, so 1 euro with respect to the rupee is approximately 109.40. If you consider the British pound with respect to the rupee is somewhere around 127.10. If you are considering Japan, so in Japan we use the 100 yen. So 100 yen will be approximately rupees 59.75. If you consider Australian dollar, AUD, as on today, the rate of Australian dollar is somewhere 66.90. If you consider Singapore dollar, that is SGD, so Singapore dollar is somewhere around 73.55. Okay, so these are just the exchange rates as on today. Okay, so the rates as on today are called as spot rates. So we also got the concept, the rate which is prevalent today. So today if you go to a bank, today if you go to a foreign exchange dealer and you ask them for the rate, that rate prevailing today is known as the spot rate. Okay, so that is spot rate. And while I was telling you about spot rate, I mentioned the word if you go to a bank. So what is a bank? Bank is one of the participants in the foreign exchange market. So the next concept is, who are the participants? Again, a theory question they may ask either in MCQ 2 marks or in a long theory question, which is question number 8 for 5 marks. So who are the participants in the foreign exchange market? So who are the participants? Number 1 participants are commercial banks. Commercial banks. So commercial banks are the banks which are doing business. Okay, if it can be a foreign bank like Citibank, okay, it can be a nationalized bank like SBI, it can be a private bank like ICICI Bank. So they are commercial banks whose main business is buying and selling of currency. Then it can also be the central bank of a country. The central bank of a country. So for India, say RBI. But what is the role of RBI? RBI is more into the regulation of currency. Okay, controlling the fluctuations of the currency, the legality of the currencies. Okay, that is where the RBI will come into the picture. Then another participant is the MNCs. what we call as the multinational companies which have offices, factories, development centers in different parts of the world. So obviously they are dealing in multiple currencies. So such MNCs are also an important constituent because they are the ones who are doing the transactions, buying, selling goods, services, transfer of money, expenses internationally, and so on. Then another participant is the law, that is our Foreign Exchange Management Act, FEMA. So how are they participating? By regulating, by making laws, cross-border transactions, cross-border merger rules, regulations. So that is how they are also a part of this foreign exchange market. Okay, the regulating agencies, that is FEMA. Then we have the retail customers. Now, who are the retail customers? Retail customers are you and me who use currency for vacation outside India. People go outside India as students to study. People go outside India for business meetings. People go outside India for medicine, that is for surgeries and so on. Okay, we hear this sportsmen that if somebody is injured, they have traveled to London for a surgery, they have traveled to Singapore for a surgery, a medical procedure. So they all fall under the retail category. Okay, so tourists, students, medical and so on, they are a part of retail. Then there are speculators. They are speculators who are trading in the currencies purely for the purpose of making a profit. So they are also buying heavily, selling heavily. So they are also affecting the foreign exchange rates. So we call them as speculators. Then there are huge treasuries. There are huge treasuries. Now, who are these treasuries? So, treasuries are organizations with huge idle funds. Okay, for example, it may be a foreign university. Okay, you may be aware that foreign universities, they receive a lot of grants and donations and so on, but they don't spend the entire money in the same year. And therefore, such treasuries, such huge chunks of foreign money is there with companies, and they also invest in various markets. Okay. Then there is investment bankers. You must have heard names such as Goldman Sachs, JP Morgan and so on and so forth. So they have international clients, they collect money from different clients, they invest in different countries. So what are they doing? They are collecting money in their own foreign countries and they are investing in Indian markets, for example. Recently, you may be aware that the IPL team, okay, RCB, the winners. So RCB's ownership changed. Earlier, RCB were owned by the United Breweries, but now the ownership changed and now one of the owner is a foreign investment banker. So obviously, if they are putting money in RCB, they are bringing money from outside India into India, obviously by FEMA approvals, RBI approvals, and now they are investing in India. So what are they doing? They are also participating in the foreign exchange market. And not to forget, along with FEMA, there are also the foreign exchange dealers. Okay, there are also the Forex dealers. There is a separate association called as FEDI, Foreign Exchange Dealers Association of India. So you may be aware that if you want dollars or if you want pounds or etc., so either you go to a bank which is also part of a foreign exchange dealer, or you can go to a money changer, what we call them as money changers. So these are RBI approved authorities, RBI approved agencies who have a license. So if I want, means for example, if I am traveling to say Singapore, And if I go to the foreign exchange dealer asking for Singapore dollars, then he will first check my passport, he will check a valid visa, and then he will issue me Singapore dollars. For any other currency, I should have a valid visa. So they also have some rules and responsibilities, some things to check before they give us the foreign currencies. Okay, so 9 points we have put forward. So if question comes for 4 marks, 5 marks, then you will be able to answer. And in the MCQ part, they may ask a question that following is a participant, or they may ask a question following is not a participant. So we have 9 points, but maybe in the MCQ they put 1 point as stockbroker, and stockbroker is no longer here. So that will be the odd man out. Okay, so we have speculators, we have treasuries, and we have companies. Okay, but stockbroker is not one of them. So that's how the question may be asked. Okay, so we have covered the basic, what is a foreign exchange market. Okay, then we have covered the features of the market, the exchange rate, the concept of spot rate, and now we also covered the participants in the foreign exchange markets. Okay, so as I said, we'll first discuss all the conceptual part, and then we'll go to the calculation part. The MCQs I have already solved of the last 9 exams. Okay, that video is already there. Okay, so it is exam wise MCQs we have solved right from December of 2022 till the December of 2025. So whatever Forex questions of MCQs were asked, it is solved there with step-by-step calculations, everything. You can see those and you can get the idea of how to solve. And today at the end of the session, we are going to solve the bigger questions, that is the 7 marks questions which have been asked on Forex. Okay, now let us go ahead. The next topic of discussion revision is Forex quotations. So quotation means how the currency is expressed. Okay, how the currency is expressed, that is called as Forex quotation. So primarily there are 2 types of quotations. First is called as direct quote. So what is the meaning of direct quote is, direct quote means in simple language, the foreign currency is kept as constant 1. And our local currency will change accordingly. Okay, I'll repeat. In case of direct quote, what we do is that we keep the foreign currency as constant and we change our local currency. Means, for example, if I am in India, my home country is India. So what I do, I keep the foreign thing as constant. So I'll keep my dollar as constant and I will say is rupees 95. If tomorrow the rate changes, I will say $1, but now 95.2. Again the rate changes, I will say $1 is 95.5. So what is kept constant? The foreign currency is kept as constant, maybe 1. If it is yen, then either we use 1 or we use 100 yen, but the foreign unit is kept as constant. Okay, now suppose if we take another example, if you are taking now, suppose let us go to USA. If we are in USA, okay, so if we are in USA, so what will happen is we will keep the foreign currency as constant. So if you are talking of USA, so they will keep pound as constant. 1 pound is equal to $1.34. See here what I have written. So I am in USA. Okay, for USA, pound is a foreign currency. So what they are writing? They are writing 1 pound is equal to $1.34. Okay, now let us go to another example. Now if I am going to Australia, okay, just now we have written the rates here. If I go to Australia, and then in Australia what they are going to write, if they are comparing with say Singapore dollars, okay, so they will write in Australia 1 Singapore dollars, foreign currency is constant, is equal to 1.10 Australian dollars. 1.10 Australian dollars. So we are in Australia. So it's very important to identify which country you are. So if you identify the home country, okay, then the foreign currency has to be kept as one constant and the domestic will fluctuate accordingly. Okay, will fluctuate accordingly. So if I write $1 is equal to rupees 95, I can also write, okay, I can also write rupees 95 per dollar. This is the same thing. This is the same thing. Okay, so either I write rupees 95 per dollar, or I may write $1 is equal to rupees 95. Okay, so this kind of a equation is called as a direct quote. Now the opposite of this is indirect quote. Okay, the opposite of direct quote is indirect quote. So I'll repeat what happened in direct quote. Here the foreign currency is constant, and the opposite happens here in indirect quote. The local, that means domestic currency, is kept as constant. The domestic currency is kept as constant and the foreign currency will fluctuate accordingly. Okay, let us see the example. And how to convert from direct to indirect. The conversion also is very simple. I'll write down here itself. For converting it, okay, see here, direct quote for conversion, you simply do the reciprocal. So direct quote, if you want to go to indirect quote, you simply do 1 upon. Simply 1 upon. So now I'll just show you how we will do it here. So okay, here I have taken this rate. Okay, this is a direct quote. Now if I want to convert it, then I do 1 upon 95. So I will get the rate 1 rupee is equal to, see now I'm in India and I'm keeping rupee as 1. So 1 rupee is equal to $0.0105. This is the same as this. I'm just doing the reciprocal. Now the second thing, this we will do it now. So $1 is equal to 1 divided by 1.34. $1 is equal to pound 0.7462. So this is done. Now let us do Australian dollar. So 1 AUD is equal to SGD 1 divided by 1.10. So 0.909. So this is the concept. Okay, this is the concept. I'll take one more example so that you understand even better. I'll take a third currency now. So another currency I will take. Now if I am suppose in Thailand. Okay, if I'm in Thailand, so Thailand currency is 1 baht. So 1 baht is rupees 2.50. This is the rate. 1 baht is equal to rupees 2.50. Now how to interpret this? Okay, how to interpret this? If I am in India, okay, if India is my home, then this rate will be direct quote. If I am in India, then this will be direct quote. If my home is in Thailand, then this will be indirect quote. So the rate is the same. We just have to see from which angle we are looking at it. Okay, from which angle, and the angle changes, the answer will change. Means, for example, I am sitting in front of you. Okay, and then what will I do is, if we say that let us raise our hand, on this side. You also raise your hand on this side. I will also raise my hand on this side. So I raised my hand. You also raised your hand. But now what happens is I am raising my left hand. You are raising your right hand. Okay, so I just said raise the hand on this side or raise the hand on this side. So if I raise my hand on this side, so for me it's a right hand. For you it's a left hand. We both are correct, but we are on opposite sides of each other. And that is why from India's point of view, it is a direct quote. From Thailand point of view, it will become indirect quote. And how to convert from one to the other? Again, it is simple. If you want to convert, so if 1 baht is equal to this, so 1 rupee is equal to how many baht? 1 upon 2.50. So the answer will be 1.40. So the conversions are also easy. So what is the meaning of direct quote? So direct quote means the foreign currency is kept as constant and the local currency fluctuates accordingly. This is direct quote. And what is indirect quote? So indirect quote will be the home currency will be kept as 1 and the foreign currency will fluctuate accordingly. And how to convert from DQ, that is direct quote, to indirect quote? Simply do a reciprocal of the same and then you can convert it. That is the concept of direct quote and indirect quote. Okay, so I hope you have got the concept of direct and indirect quote. Now another type of forex rates. Okay, so example, suppose you go to a bank and you ask the banker that what is the dollar rate, and the banker asked you what do you want, and I was confused. So again I asked the banker nicely what is today's dollar rate, and he asked, hey, what do you have to do? I thought there is some communication issue, so I asked in Hindi that sir आज का डॉलर का रेट क्या है, and he replied तुमको क्या करना है. So I was kind of not very amused by the rudeness of the banker. So I went to the manager, I went to the senior, and I asked the same person to the senior person that sir आज का डॉलर रेट क्या है, and the senior also asked me the same question, तुमको क्या करना है. So I told him this is not a way to talk to a customer, and he is like, sir, it's a genuine question that what do you want? And that is when I realized my mistake, because he was asking me indirectly whether I was there to purchase the currency or whether I was there to sell my currency. Okay, so basically what is the scene is, for a currency there are two rates available. See, for a bank, for a foreign exchange dealer, currency is business. And what is the rule of business? The rule of business is there are two rates. One is the buying rate, one is the selling rate. So what normally you do? You buy at a lower rate, you sell at a higher rate. Normal business rule. So same thing happens in case of a bank. So in a bank or a foreign exchange dealer, you will find there are two rates. One is called as the bid rate and other is called as the ask rate. So what is the bid rate? Bid rate is the buying rate. Bid rate is the buying rate of the bank. Most important, the bank is buying. And what is ask rate? Ask rate is the selling rate. Ask rate is the selling rate of the bank. So important words are, these are the rates of the bank. So bank is buying, so bid rate. Bank is selling, therefore ask rate. Okay, and now let us see a correlation. So the bid rate is applicable to the exporters. So in the question, if the wording says XYZ company is an exporter, so always remember exporters will get the bid rate. And in the question, if they use the word ABC Limited is an importer, so importer will be applicable to the ask rate. Because what happens is, an importer has purchased goods from London, for example. So importer wants pounds. So importer will go to the bank and tell the bank, I want to acquire pounds. So the bank will sell pounds to the importer. And therefore, importer will always get the ask rate, selling rate. Exporter will always get the bid rate, that is the buying rate. Okay. And obviously, for a bank to make a profit, what the rates will be, I'm just giving an example. If $1 is say rupees 94, this is the bid rate. So if the ask rate will be obviously higher, say 95. So normally speaking, the bank will make a profit. So if I am the exporter, I go to the bank and I give them say $1 lakh. So how much the bank is going to give me for 1 lakh? They will give me 94 lakh rupees. But if I want $1 lakh, I have to pay 95. And therefore, the difference between these two rates is the profit of the bank, and in the technical terms, this is called as spread. So what is the meaning of spread? The spread is the difference between the bid rate and the ask rate. So this difference will be the profit of the bank. Okay, so in our example, so the bid rate was 94 and the ask rate was 95. So the difference between them, 1 rupee per dollar. 1 rupee per dollar will be the spread. That means this is the profit of the bank. See, bank is doing these transactions not for social service. Bank is doing the transactions for business. It is a part of bank's profit. And that is why the bid rate, okay, the bid rate will be the lower one and the ask rate will be the higher one. Okay, the bid rate will be the lower one. This is the normal rule. But suppose this rule will depend on the quote. So then what is the rule? The rule is, if the data is given in direct quote, if the information is given in DQ, then the bid rate will be lower and the ask rate will be higher. This is the normal situation if the data is given in direct. But if the information is given in direct quote, then the data information will be changed. It will be bid high and ask low, because the rates are given ulta, and therefore our rule also will become ulta. See, please remember, in both the cases, the bank is going to make a profit. Okay, in both cases, the bank is going to make a profit. Okay, so in majority terms, the direct quote will be given. So in India also, we follow the direct quote mechanism. Okay, that's why if you see in the Indian market, in Indian newspapers, we'll always see $1, €1, £1, and the rupees always going up and down, rupees going up and down. Okay, so what we do in India, we follow the direct quote mechanism. Some other countries may follow their own systems, but as far as India is concerned, we follow the direct quote rules. Okay, so this is a example, or this is a meaning of direct quote, indirect quote, bid rate, ask rate. Bid rate is the buying rate of the bank. I am repeating, you have to think from the bank point of view. So bank is buying. So who is selling to the bank? Exporter. So exporter is the seller. And see here, bank is the buyer. Exporter is seller, bank is buyer. In this case, importer is the buyer and therefore bank is the seller. So exporter will be applicable to bid rate, importer will get the ask rate. So few basic points keep in mind. Okay, now let us go ahead. Now there is a common thing that currencies fluctuate every day. Okay, the forex fluctuations, this happens every day. And when you say forex fluctuations, so it may mean, okay, example, if $1 today is rupees 94, this is today. So today means spot rate. When you talk of today, today is the spot rate. So spot rate is $1 is rupees 94. So tomorrow this $1 may become 93 or this $1 may become 95. Dollar is constant. So which quote we are talking? We are talking of direct quote. We are in India. So either I write $1 is equal to rupees 93 or I write this way. Meaning is same. So on the left hand side I am saying $1 is equal to rupees 93 and here I am saying rupees 95 per dollar. So meaning same, $1 rupees 95. So now what is happening is today's rate is this and the rate in the future is called as forward rate. The rate which will be in the future will be called as forward rate. The rate which is prevailing today is called as the spot rate. Okay. Now what is happening here? Let us check. So today $1 is 94 and tomorrow the same $1, if I have to pay 95, I am paying more money for the same dollar. Okay, I am paying more money for the same dollar. So we say that in this situation, dollar has become strong and rupee has become weak. This is what we mention if today's 94 becomes 95. But if today's 94 becomes 93, so dollar is cheaper. Today if I go to the bank, I have to pay 94, but tomorrow I pay 93. So it is cheaper. So when dollar becomes cheaper, we say that the dollar has become weak and the opposite is rupee. So rupee has become strong. Yes, please remember it's a fight between two. If one will win, the other will lose. So if one currency has become strong, the other currency obviously has become weak. Okay, so it's just between two. So the example, today's rate is spot rate. Suppose we assumed as 94 and tomorrow anything may happen. So if 94 become 95, dollar has become costly. So when this happens, today's 94 becomes 95, we say that the dollar is trading at a premium. So premium means I have to pay extra for the same dollar. But if today's 94 rupees becomes 93 or less than that, I say that the dollar is trading at a discount. I say that the dollar is trading at a discount. Okay, so again questions have been asked in MCQs that okay, find the premium amount, find the discount. So first of all, how to identify? If today's dollar is 94 and it increases 95, 96, 97, then we say that dollar has become strong. And when dollar has become strong, that means it is trading at a premium. But on the other hand, if today's 94 become 93, 92, 91, then dollar is falling. So we say dollar is at a discount. Dollar has become weak. So the question which was asked in the examination is, the question was asked, what is the premium or discount percentage. Okay, so question was find out the premium or discount percentage. So the formula is forward rate minus spot rate upon spot rate into 100 into duration Now duration, why? Because it may not be always 1 year. Normally whenever you multiply by 100, the normal assumption is 1 year, but maybe the rate is only after 2 months. So if it is 2 months, then we have to do 12 upon n. Here n is duration, 12 upon 2 months. If the duration is given 3 months, then the rest everything is same. So we do 12 upon 3. If the data is given in number of days, then instead of 12, we will write here say 365 upon n. If the data is given in days, so they are given 90-day exchange rate, 60-day exchange rate. Okay, so we take 365 upon 90, 365 upon 60. Sometimes the question says assume 360 days. So we take 360 upon 90. Okay. If months are given, then 12 upon n. If days are given, then 360 upon n. But the rest thing is same. So forward or premium percentage. And when you put the data and when you get the answer, okay, whatever the answer is, if the answer is positive, if the answer is a plus, it means it is premium. And if the answer is negative, it means it is a discount. Simple. So the formula is same. If the answer is plus, it means it is a premium of say 5.5%. If the answer is minus, it means it is a discount of same 5.5%. So the amount may differ, but positive signifies premium, negative answer signifies discount. Okay, so twice the questions have been asked that find the premium percentage. Okay, such question has been asked twice in the past few exams. Okay, so hope this is clear, the premium versus discount. Now another concept is the spot rate is given. Okay, now the next concept is from MCQ point of view. Such MCQs may be asked. Okay, now for example, see here. Suppose you are given the spot rate. Okay, you are given the spot rate. Say $1 is equal to 94.20 and 94.70. This is the spot rate given. Now what is the meaning of this? 94.20 is the bid rate and 94.70 is the ask rate. That is the meaning. And okay, and you are given what is called as forward points or also called as forward margins. Forward point or forward margin. This data is given and this data is given in this fashion: 0.10 dash 0.25. It is given in this way. Okay, now next data, I'll just first put the information, then we'll explain. Suppose €1 is equal to rupees 108.50 dash 109.20. This is given, and here the information is given 0.50 slash 0.20. Now both the rates are with respect to rupees. Okay, both the rates are, so one is dollar to rupees, other is pound to rupees. And now what they have telling us, what they are asking us, they are asking us find the forward rate. So they have given the spot rate and they are asking us find the forward rate with the help of forward points, forward margins. Now, how to identify this? Then the rule is very simple. Look at the data given. Look at this data, forward points data. In the first example, the forward points are 0.10 and 0.25. That means they are in ascending order, they are rising. And in the second example, it is 0.50, 0.20, it is falling. That is the hint. So when these points are in a rising thing, okay, when these are in a rising thing, we have to add them to the spot rate. And when it is in a descending order, we have to subtract them from the spot rate. A typical 2 marks MCQ which can be asked, or maybe such data will be given in a bigger question. But hint is, if the forward margins are rising, you add them to the spot rate. If the forward margins are falling, you subtract them from the spot rates. So let me write the answers. In the first dollar situation, 94.20 and 0.1. So this will be 94.30. So 2 plus 1, and 94.7 and 25. So 70 plus 25. So 94.95 added. See, 94 is constant. After the decimal, we have to adjust them. If by adding it may go above 95, then you add 95. That's okay. In the second example, 108.50 and now minus a. So therefore it will be 108.00 because 0.5 minus 0.5 and 109.20 and 20. So 109.00. So when the forward margins are in a ascending, rising data, you add. When it is in the following information in a decreasing or descending order, then you minus it. So that is the concept, and that's how the questions may be asked. Okay, so this forward and this, all these things are a regular thing, because as I told you some time back, the foreign currency will change each and every day. Sometimes the change is small change, sometimes the change is a big change, and so on. But what is going to happen, what is the confirmed thing, that the forex rates will change every day. Every day. And the primary reason is, say, the demand and supply forces. Okay, now since we are talking of reasons, so let us go to the next heading, reasons for changes in forex rates. What are the various reasons for changes in the forex rates? Why do the rates change? Again, many reasons. Few reasons are macroeconomic, few are day-to-day microeconomic, few are legal reasons, few are technical reasons, many reasons. So let us see. First, let us take the macro reason, say GDP growth rate of a country. GDP growth rate of a country. If a country is growing at a faster rate, for example, say India and China. Okay, see, presently our economy is growing, but maybe at a slower pace than, say, last year. Okay, as compared to last year. So please remember, India is not in a slowdown phase. India is not in a depression phase or recession phase. Just that earlier our target was 7.5 GDP growth rate. Now the target is maybe 7.1 GDP growth rate. So still we are growing at a much faster rate as compared to the other economies, other countries, but our speed of growth has slightly reduced because of reasons you already know, plus I will explain in just a few minutes. So where the GDP growth rate is higher, foreign currency is attracted, and foreign currency attracted, automatically the rate will fluctuate. Second reason is political. Second reason is political stability. If a country is not politically stable or suddenly the government falls, then the foreign investment will get out of the country. Okay, the foreign investment will get out of the country if there is a political turmoil in the country. Means recently USA attacked Venezuela, captured the president of Venezuela. That shows a political instability. That's an example of political instability. So investors who had invested in that country, they will take the money outside the country. And obviously, if there is an outflow of one currency, then there will be a change in the exchange rates. So therefore, political stability is needed. Third, legal rules. Suppose the government passes certain laws either prohibiting or allowing foreign investments. Means, for example, suppose India has a FDI policy. So FDI policy in some sectors 49% FDI allowed, in other sectors 26% FDI allowed, in some sectors 74% FDI allowed, for example. If government increases the limits, that where 49% FDI was allowed, government changed the law to make it 75. So suddenly foreign money will come into India. If it earlier it was say 74, now 100% is allowed, again foreign money will come into India, and the moment dollars and pounds come here, there is a change in the exchange rates. That is the legal rules. Fourth is capital market of a country. Capital market, how the stock exchange is behaving. If the stock exchange is bearish, the market is going down, then the FPIs, the foreign portfolio investors, will take their money out of India. That is happening in the last couple of months. That whenever the Indian markets are going down, the FPIs have a big contribution in taking the money outside. And after a few months, when things will be settled, everything will be nice and rosy again, the same foreign portfolio investors will again come into India, and again the exchange rate will fluctuate. So that is another reason why there is a change. Next reason is very much known to us, very much experienced on a daily basis, that is oil prices. That is oil prices. And oil prices are rising because of shortage of crude oil. And India imports a lot of crude oil because, see, it's a natural resource. So India having a huge population, huge industrialization, but we do not have a huge say natural source of crude oil, so we have to import a lot. And I'll just connect this to the other point, and right now there are problems of wars. So why India is facing a problem of crude oil? Because there is a war between US and Israel and Iran and Lebanon, and all those countries are at war, and they are one of the controllers of the oil reserves. Iran, Iraq, Qatar, Kuwait, and it's a war-like situation. It's a war situation in that part. Russia and Ukraine are also at war. Russia also has a huge oil deposits. So because of the war, the oil reserves, oil extraction and oil supply are a problem, and since India imports oil, the currency will fluctuate. Obviously, oil will become costlier, currency will fluctuate. Another reason why currency fluctuates is gold prices. Another commodity which India consumes a lot but does not produce as much. So we are consuming but we are not producing. That means the gap we are importing. And whenever the international markets fall, whenever the stock market is hit, gold prices rise. You can see on your own what are the gold prices today compared with last year. The gold prices have gone up like anything. And since we import a lot of gold, we pay in dollars, and therefore dollar will become stronger. And that is why all these reasons, okay, last year the dollar, which was around 82, 83, is now going towards 100. It is nearly going, it is trying to breach that 100 mark. That is the main reason. All these wars, gold prices, oil prices, they are pushing the dollar ahead. Okay, that is another reason. Then next reason is interest rates in the world. Interest rate differentials. So interest rates are different across the world. So for example, if India, the FD rate, fixed deposit rate is say 6% or 7%. The same fixed deposit rate in USA is 3%. The same fixed deposit rate in UK is say 2, 3, 4%. So what the British investors think that if they invest in England, then they are going to get 4. But if they invest in India, they will get 7%. So why not invest in India? And therefore they will bring the pounds to India. The yen will come to India. Why? Because the interest rate in India is higher than the foreign countries. But whenever the currency is switched because of interest rate, there will be change in the currency rate as well. Okay, based on this, there is a theory called as interest rate parity theory, IRP, that we'll discuss in just some time. Next reason is inflation rate differences. So inflation rate differences means the prices of commodities. See, whenever your friend is going to Dubai or whenever somebody is coming from USA, you tell them, yaar, please get an iPhone for me from USA. Please get an iPad for me from Dubai. But the same model, the same iPhone 17 Pro Max, the same iPad 11 series. So why are they getting it from Dubai and USA and Singapore and Thailand? Because the same model is available cheaper in that country. If I am paying say 1,40,000 for an iPhone in India, the same iPhone in Dubai market is at 1,10,000 maybe. So there is a difference in price. So what are we doing? We are importing from Dubai, we are importing from US, we are importing from Singapore. And the moment we import, what is happening? The currency is fluctuating. So that is another reason why currency fluctuates. Next reason is government intervention. That is also happening today. That is also happening today. That is government intervention. As I told you that the dollar is trying to reach and cross 100. The government doesn't want that. RBI, that is. So what RBI does? RBI will play a role in the market. RBI will put dollars in the market. They will increase the supply of dollars in the market. So simple economics, the supply rises, the prices will fall. So rupee which was going towards 100 has been brought back to 96, 95 with the intervention, with the actions of the RBI. Okay, so these are 10 reasons why the foreign currencies fluctuate on a regular day-to-day basis. Okay. Yes, so let us go ahead. So we are just discussing all the concepts as they come and then we go ahead. Yes, the next concept is cross rates. The next concept is cross rates. Now cross rates means what? Okay, now let us take up first an example. Now suppose I am traveling from India to say South Africa. Okay, now I have Indian rupees because I am in Indian, so I have Indian rupees. And if I am going to South Africa, then their currency is ZAR, that is the South African Rand. And when I went there and I saw that I wanted to convert rupee directly into South African currency, they said that such direct thing doesn't happen. Okay. Or even if it happens, they are giving me a very bad rate. Bad rate means I'm at a loss. The conversion is putting me at a loss. So what I do is I go through a vehicle currency. So in simple language, what I'm doing is I'm converting my rupees to dollars and dollars to South African currency. So it's a three-way route. So when such three currencies are involved or more currencies are involved, we use the concept of cross rates. I'll give you a simple example to understand this cross rate concept. Okay, now suppose in India itself, okay, in India, suppose if I say that one pizza is 400 rupees. Okay, one pizza is rupees 400 and one burger is rupees 200. ठीक है, very basic example. In India itself, one pizza is rupees 400, one burger is rupees 200. And now if I ask you, how many burgers are needed to buy one pizza? The answer is very quick. 2 burgers are needed to buy one pizza. So earlier I told you both the prices in rupees. So rupee common, and therefore now what is the equation? Equation is one pizza is equal to 2 burgers. That is the concept of cross rates. Okay, so one pizza 400 rupees, one burger 200 rupees. That means one pizza, 2 burgers. Cross rates. So let me put here, let us take an example. Now suppose if I say that $1 is equal to rupees 95. Okay. So now how will I write this? I write this in this fashion: dollar upon rupees is equal to 95 upon 1. If you cross multiply, $1 is equal to rupees 95. Then I will write 1 pound is equal to rupees 127, for example. So how do I write this? I write this as pound upon rupees is equal to 127 upon 1. So now if you see both the equations, dollar with respect to rupee, pound with respect to rupee, rupee common. And now what we want is, we want this 1 pound is equal to how many dollars? This is what we want. So from dollar to rupees, pound to rupees, we want the third relationship. What is third relation? Pound to dollars. And therefore what I want this pound upon dollar is equal to pound upon rupee multiplied by rupee upon dollar. I want rupee to cancel itself. Rupee is the common currency. It should be cancelled. So let us see. First equation is this: pound upon rupee. I already have a ready-made equation. Pound upon rupee 121 upon 1. Ready-made, available. Second, rupee upon dollar. So rupee is up. But in the equation which I have, rupee is down. So what I do? I reciprocate. So 95 upon 1, I will do opposite, 1 upon 95. This one I reciprocated. And therefore you get the new equation now. So 127 divided by 95. And therefore we get the value. Pound upon dollar is equal to 1.3368. In simple language, 1 pound is equal to dollar 1.3368. This is the concept of cross rates. And if you are given bid rate and ask rate, so how to do that? Bid rate of one compare with bid rate of the other, ask rate of one compare with the ask rate of the other. Again do the same cross multiplication and you will get the new rates. Okay, so after this we go to the next concept which I told you just some time back, that is the interest rate parity theory. Interest rate parity, IRP. And questions have been asked in the past few exams, okay, MCQs as well as the long questions on IRP theory. Now what does interest rate parity tell us about? They say that different countries have different interest rates. Okay, different countries have different interest rates, and investors invest in high interest areas. Investors will invest in high interest countries. But because of such investors traveling from one place, the money shifting to the other country, okay, there is a change. There is a change in the forex rates. And see, I am investing today, but in the future my investment will mature and I have to take the money back. So if today foreign money comes in for 1 year, after 1 year it will mature, the FD will mature and the money will again go back. So as per the IRP, so this is what you have to remember from the MCQ point of view as well as that. So what does IRP say? That IRP says that the country where there are high interest rates, the country having high interest rates, their currency will fall in the forward market. Their currency will fall in the forward market and vice versa. It means that today, for example, today the exchange rate is $1 rupees 94. Okay, $1 rupees 94 is today's rate, spot rate. India's interest rate is 8%, whereas US interest rate is say 4%. Okay, US interest rate 4, India's interest rate 8. Okay, I'll just put it on the screen so that it is easier to understand. So just for example, India's spot rate is rupees 94 per dollar. The interest rate in USA is 4% per annum and interest rate in India is 8% per annum. So what does the IRP say? IRP says the country where interest rate is high. So which country has higher interest rate? India. So where the country's interest rate is high, that same country's currency will fall in the forward rate. So the forward rate, India's currency will fall, means Indian rupee will depreciate, and that means the forward rate may be something 96, 97, etc. So using this theory, okay, this is a theoretical concept. Okay, this is a theoretical concept to identify which direction the forward rate will be. Okay, so what is the theory say? The theory says that the country having higher interest rate, its local currency will fall in the forward market. That is the proposition of the theory. So this theory is used to estimate the forward rate. Okay, so what is the formula given for this? The formula given is 1 plus RD upon 1 plus RF is equal to forward rate upon spot rate. Formula is 1 plus RD upon 1 plus RF. What is RD? RD is interest rate in domestic country. Okay, interest rate in domestic country. What is RF? Interest rate in foreign country. What is forward rate and spot rate? So out of these 4, 3 will be given to you. Okay, in one of the exams they had asked you this, forward rate was to be found out. In another exam they had given this and they had said find this. So three figures will be given. Okay, 3 figures will be given. You have to find the 4th one. That's it. So just put the formula, replace the 3 figures and then solve. The only thing you have to be careful is these rates are given as per annum. And suppose the question says that 3 months is the duration. Okay, so just don't forget, if it is 8% per annum and they say 3 months, so in the formula you have to write 8% into 3 by 12. If they are given 4% and they are saying 4 months, then you do 4% into 4 by 12. So don't forget to convert it into the duration, actual duration. Many times the student forget this step. So data is given per annum. Check the duration, 2 months, 3 months, 4 months, accordingly adjust 2 by 12, 3 by 12 and so on, and then you will get the desired correct answer. So that is the concept of interest rate parity, PPP. It is used to identify the forward rate, IRP, sorry. Now similar, we go to another theory called as purchasing power parity. Like interest rate parity, another theory which is used, okay, another theory which is used for deciding, estimating the forward rate. Other theory is purchasing power parity, PPP, purchasing power parity, and this is related to inflation rates. This theory talks about inflation rate and its effect on forex rates. So in one of the MCQs they had asked that interest rate and relation. So interest rate is IRP. Another MCQ they had asked inflation rate changes. What will be the effect? Which theory? PPP, purchasing power parity. Okay. So again the same logic, that inflation means prices. Purchasing power is related to prices of commodities across countries. So same thing, the country where prices are lower, okay, country where prices are lower, people will prefer that country. Okay, sometime back I gave you the example, if an iPhone is cheaper in Dubai, then Indians will import iPhones. Indian tourists will buy the iPhones from Dubai. And obviously if you are buying from Dubai, so it is import, so we have to pay in dollars, so there will be a fluctuation in dollar rupee rate. Or if you are directly going in Dubai currency, then dirham, so dirham rate will be fluctuating. So inflation is ruled by purchasing power parity. And similar to IRP, here also there is a similar formula. So I'll just jot down the formula. So what does the formula say? 1 plus ID upon 1 plus IF is equal to forward rate upon spot rate. 1 plus ID. I here is inflation rate. So inflation rate in domestic country upon inflation rate in foreign country is equal to forward upon spot. Again 3 information given, 4th one you have to find out. Same for what we use for IRP. If duration is given, number of months, here also adjust it for number of months, because inflation also is per annum. Okay. So for PPP they have not asked any MCQ as yet, but they had asked MCQ theory, not numerical, but theory they had asked ki PPP relates to what. So they were given the options, it relates to interest rate, relates to inflation rate, both of them vagara. So answer is inflation rate. So that is the concept of PPP. It is used to find again the forward rate. Okay, so that concept also we have covered. Now going forward, next concept is risk in forex market. Now we are shifting towards the risk in forex, and the moment we say risk, then we also have to consider risk management. So the meaning of the risk, we know risk is simply the change in the expected values. So I thought that the dollar will fall, but actually the dollar has gone up. That is risk. Somebody else thought the dollar will be constant, but the dollar fell. That is risk. So anything which happens, which is different from your expectation, that is called as risk. So in case of foreign exchange, okay, there are 3 types of risk primarily. The first type of risk in forex market is called as transaction risk. most common and most serious kind of risk. So transaction risk means the change in cash flows, due to forex rates. So most important, transaction risk, the cash flows are affected. Means, for example, I'll give you example. If suppose dollar falls, okay, between dollar and rupee, if dollar falls, then exporter will have a loss. But suppose if dollar rises, then importer will have a loss. So that means, loss means my money is gone. See, as an importer, for example, as an importer, I had bought goods of $1 lakh. I had purchased imported goods of $1 lakh, and that time the dollar was 93 rupees. So I was supposed to pay 93 into 1 lakh. So 93 lakh I was supposed to pay. But by the time the due date came, by the time the payment date came, dollar has become 96. So instead of paying 93 lakh, now I have to pay 96 lakh. I have to pay 3 lakh more. My 3 lakh cash flows are gone. Why? Because dollar shifted from 93 to 96. So this is a straight away hit to the cash flows and obviously the P&L. So when profit is affected, cash flows are affected, it is called as transaction risk. Very common and that much serious because your money is wiped off. Okay. The second type of risk is translation risk. The second type of risk is translation risk, also called as accounting risk. Translation risk, also called as accounting risk, because it does not hit your cash flow. It is only an adjustment in the P&L account. It's an accounting entry. Means what? For example, we have to close the accounts. We know that we have to close the accounts, our balance sheet, P&L, we have to close on 31st March every year. Okay, every year we have to close our accounts 31st March. In case of quarterly, then 30th June also, 31st December. So there is a period closure. And as per the rules of accounting, we say that balance sheet as on 31st March, that means my foreign debtors, foreign creditors, foreign assets, foreign investments have to be translated. That means have to be shown as at the rates on 31st March. Means, for example, I had imported goods in February. Okay, I had imported goods in February and due date was in June. So actual payment will be June. But when did I purchase? When did I import? February. So it is showing in my balance sheet on the liabilities side, okay, import payments, and the value, for example, the value is 120 lakh. Then came 31st March in between. Payment is June. That has time. But on 31st March, all the foreign receipts, all the foreign payments are to be restated, converted into the exchange rate of 31st March. So originally my 120 lakh liability, on 31st March, it shows 122 lakh to be payable because the rate has changed. So what I have to do, this 2 lakh I have to show as a loss. Have I actually paid the money? No. And therefore, I have to make a accounting entry to show the loss. So cash flows are not affected here. Cash flow not. Okay, cash flows are not affected in case of translation risk, but only the balance sheet P&L have to be adjusted for the losses. So this is called as translation risk. And the third type of risk is economic. The third type of risk is economic risk or economic exposure. The word exposure also means risk. So here what happens is, because of Forex changes, my future values will change, and therefore, see, for example, if you are taking a capital budgeting project, in capital budgeting what you do, we find out the NPV of a project for next 4-5 years. But suppose in that NPV my project is involving imports. So I have done the cash flow analysis, cash flow after tax, everything, considering today's exchange rate. But if in the future the dollar appreciates, the pound appreciates, all my imports will become costly and my NPV will fall. And if NPV falls, the project value goes down. And if project value goes down, my business value also is affected. So economic exposure is the valuation being affected. So business value going down because of Forex. Business value going down because of Forex. So this is called as economic exposure. Okay, this is called as economic exposure. So if a question is asked that what are the types of risk in foreign exchange, so transaction risk, okay, translation risk and economic exposure. These are the three types of risk. Theory question as well as in MCQ they may ask the risk which does not affect cash flow, translation risk. The risk which always affects cash flow is transaction risk. The risk which is affecting future values is economic exposure. Okay. So now let us go ahead. So now where there is risk, there is risk management. Okay, where there is risk management. And risk management is classified into two parts. One is internal techniques of risk management and external help. Internal techniques of risk versus external help. So in internal techniques of risk management, the first and most I'll not say easiest, but the best method is denomination in local currency. Denomination in rupees. Means, for example, if I import the goods and I make a contract that I will pay you in rupees. Now you may know, okay, recently India has signed a treaty. Indian government has signed a treaty with various countries that we will buy oil from you and we will pay you in rupees. Best example is India-Russia. That whatever oil we are importing from Russia, we are paying them in rupees. And since we are paying in rupees, there is no effect on currency fluctuation. That's the best method of risk making zero. If everything is done in rupees, see why the problem comes that I am paying in dollars, I am receiving in euro, I am receiving in yen, I am paying in pounds. So my transactions are in different currencies. But imagine when I export, I get rupees. When I import, I pay rupees. No risk. Risk becomes zero if I am able to do this. Another method of risk reduction is foreign currency bank accounts. Okay, another way of reducing risk is you open a bank account, but not in rupees, you open an account in dollars. You open a bank account in pounds. Foreign currency based bank accounts. And you can do that in India as well. Means, for example, if I am selling goods, I'm an exporter. So the money is coming in dollars, and so I don't convert it. I keep the money as it is in dollar form. And tomorrow I have to pay also in dollars. So what I do, I don't have to go to some new foreign exchange dealer. The same money which I have in my bank account, they are also in dollars. I'll import using the same money. So what is happening? Money is coming, I'm keeping in dollars. Payment is to be done. From that only I'm making the payment. So what is the advantage? That my conversion is very less. And lower the conversion, lower the risk. So that's how you can also reduce the risk using foreign currency bank accounts. And examples of foreign currency bank account you must have heard. There is something called as Resident Foreign Currency Account, RFC. Then there is Exchange Earners Foreign Currency Account, EEFC. EEFC, that is Exchange Earners Foreign Currency Account, Resident Foreign Currency Account. So these are accounts which we can maintain in US dollars or pound or yen, which will reduce our foreign currency risk. Another method of risk reduction is leading and lagging. Leading means to prepone and lagging means to postpone. So what we will do is that if I think that the dollar is going to fall in the future, suppose I am the importer, I am the importer, and if I believe that dollar is going to fall in the future, so as an importer, it is better for me to pay late because dollar will fall in the future and therefore I have to pay less. I will postpone the payment. I will lag for my benefit. On the other hand, as an importer, if I believe that dollar will be strong in the future, means today dollar is 94, dollar will become 98 in the future, then I will not wait for the future. I will prepone my payment. I will tell the person, I'll pay now, give me a discount. So I'll benefit in two ways. I'll pay now at a lower rate, plus if I'm lucky, I'll get a discount as well. So importer exporters, what they do is they try to prepone, which is leading, postpone, which is lagging, the settlements. So what are we leading and lagging? We are leading and lagging the settlements, actual payment, receipt payment. We are postponing. Why? We expect more money in the future. We are preponing. Why? We will have to pay less right now. So whichever is beneficial, companies will do that just to save money, save losses, earn more profits. So that is leading and lagging. Another method is netting and matching. Netting and matching. Now netting matching in simple word, it is set off. It means set off. Means suppose if a company, suppose say Infosys. Now Infosys has purchased laptops from Dell. So Dell is a US company, Infosys is an Indian company, and they have imported laptops from Dell. So they have to pay. They have to pay Dell in US dollars. At the same time, Infosys provides services to Dell and they have to receive money in US dollars from Dell. So between Infosys and Dell, Infosys is a customer also and a supplier also. So Infosys is an importer also and an exporter also to the same company, that is Dell. So instead of making two payments, means suppose I have to pay you 100 and I have to receive 120. Why to have two big transactions? So I have to pay you 100, I have to receive 120. So you do a set off, netting. So 100, 120, difference is 20. So the transaction is settled for 20. So automatically, instead of a huge amount conversion, now the conversion is only the differential amount. This is the concept of netting and matching. So the conversion amount less, automatically risk becomes less to a great extent. Another method of internal risk management is price variation. Another method is price variation. Now what happens in price variation? The seller, for example, the exporter knows that I sell today at some rate and tomorrow because of fluctuation I will receive less money. The exporter is afraid that in the future the dollar will fall, the pound will fall, for example. So exporter is thinking that I will receive less money. So what exporter tries to do is he will increase the invoice value today. Okay, I'll give you an example. Now suppose I am a shopkeeper. Okay, I'm a shopkeeper and I know that, okay, whatever price I am going to tell the customer is going to negotiate, the customer will bargain. So if I tell the customer that, sir, this handkerchief is for 50 rupees, the customer says, okay, I'll pay you 30. Customer says, okay, I'll pay you only 20 rupees. हाँ भैया देने का बोलो. So what I am doing is I know that if I tell them 50, they'll bring me down to 30. So what I am doing, I am telling them a higher price. So they ask me what is the price of handkerchief, I tell them 75. And they said नहीं 75 नहीं भैया नीचे आ जाओ 50 में दे दो. I said okay, take at 50, which was my original price 50. So to protect my money, I have inflated the prices today, because even after future losses, I'll still be protected, I'll still be safe. So this method is called as the price variation method, wherein the exporter will increase the price to adjust the future losses. That is what they do. Next method is money market hedge. Very important questions are asked for 7 marks. Money market hedge. So what is money market? It is a short-term market, less than 12 months short-term market. So like money market we have in India, money market we have in US, UK, Europe, etc. So we take advantage, or rather we use the money markets of both the countries. Okay? And why do we use them? For hedging purpose. What is the meaning of hedge? Hedge is to take an opposite position. Always remember, the meaning of the word hedge is taking an opposite position to protect myself. And the same thing we do in money market hedge, that if I am an importer, okay, later on I am going to solve entire questions on this. Okay? Proper numerical exam questions I am going to solve. So what the concept is in money market hedge, if I am an importer, for example, I am an importer, that means I have a liability. I have a liability. What is the opposite of liability? Asset. So what I do is I create an asset. I create an investment. That means an asset in the foreign country. Right now I'm just giving you a small part, and later on I'll solve the entire stuff. Okay? So I'm just telling you the concept of opposite. So I've imported goods from US and I have to pay them liability after 2 months, for example. So what I do is I invest in US today. That means I create an asset today with a maturity of 2 months. So what will happen after 2 months? After 2 months my investment will mature and my liability is already there. Okay, so what I'll do, whatever that investment maturity amount, that amount of investment maturity will be used to pay the liability. Finished. That means after 2 months, there is nothing to convert. So even if the rate changes upper niche after 2 months, I don't care, because I've already made an arrangement there. Second example, if I am an exporter, that means right now I have an asset, receivable asset. So what I do, I take a loan in that country, opposite. That means I create a liability in that country. Example, I have to receive money after 3 months from UK, London. So I have to receive money after 3 months. What I do, I take a loan today from London with a maturity of 3 months. Okay. And then what will happen? After 3 months, I have to repay the loan. But after 3 months, my London receivable is also due. So I tell my London customer, put the money in that bank account from where I have taken the loan. So directly the money will be settled in London itself. No conversion after 3 months. So no conversion after 3 months automatically means I am protected. So that is in simple language how this money market hedging happens. So when we solve the numerical, it will be even more clear for all of you. Then when you talk of external hedging, in external hedging we are talking of forward rates. We enter into a forward rate with a bank, means we pre-decide the rate that I have to make a payment after 2 months. Today rate is 94.5. Let's fix a rate of 95. No matter what happens. You fix the rate with a bank. That's it. That is the forward rate. Simple. Decide the rate today. Actual settlement at maturity. Now no matter what the actual rate is, जो rate हमने decide किया है, that rate will be used for settlement. Then you also know that if we do much more sophisticated, it can be a futures contract. We can do that through the organized exchange. Okay, we can do it through an exchange, a proper contract through the exchange, margins, initial margin, etc., etc. Same logic. Third, we can have an options contract. All these things you have learnt in derivatives, options contract. So what will happen in the options contract? There will be a right to buy. So generally the call option will be taken by importer because importer has to buy currency. And the put option will be taken by the exporter because exporter has to sell currency. So such contracts will be done by importers and exporters to protect themselves. Okay, to protect themselves from the foreign exchange risk. Okay, so importer, because he is buying, so he will have a call option, call buyer. Exporter, he is selling, so he will have a put holder. Then another thing you can do is you can have a currency swap as well. Currency swap between two countries, two companies. You swap the currencies today with a later re-exchange. So it will be an OTC contract between the two parties. So different methods of risk management. Okay, so risk management will have internal techniques as well as the external techniques. So whole idea is, okay, what is the whole idea? Whole idea is to protect yourself from the risk. Transaction risk, translation risk, economic exposure. Okay, going forward now, we are nearly at the end of the conceptual part. Thereafter we'll have the numerical part. And the last thing we can do using currencies is we can do arbitrage. Now what is the meaning of arbitrage? Arbitrage is to take advantage. The meaning of arbitrage is to take advantage due to difference, or you can use the word imbalance. Taking advantage due to imbalance, difference in market prices or market rates. That means there is an ideal market, but that is theoretical. So if the actual market is different from the ideal market, okay, that gives rise to an arbitrage opportunity. Now this arbitrage opportunity may happen in terms of IRP, interest rate parity. It may happen with respect to purchasing power parity. Because what these two theories tell us, that they tell us that based on interest rate, this is the ideal forward rate. Based on inflation rate, this is the ideal forward rate. But if the ideal forward rate is different from the actual forward rate, there is a chance of making money. There is a chance of saving money. Means, for example, if I am talking of let us take an example of inflation. Okay, now suppose if I have to buy an iPhone. Okay, I have to buy an iPhone, and in India, when I check the prices of iPhone, the price of iPhone in India for that model is say 1,50,000. Okay, 1,50,000. Now, ideally, when I divide this using the exchange rate, okay, when I divide this 1,50,000 divided by the exchange rate of say US dollar. So US dollar exchange rate is say 95 approximately I am taking. So ideally the same iPhone in USA. So what I have done, 1,50,000 to India's price divided by 95 rate. So the price of that iPhone in US dollar has to be 1,578 or $579 ideally. I'll repeat, the iPhone in India is at 1,50,000 and the currency rate in India with dollar is 95. I simply divided, so I got 1,578. This should be the price of iPhone in US. But when I check the market, the price of iPhone in US is $1,200. So ideal price 1,570, actual price 1,200. It is cheaper. So what is the arbitrage? Buy in USA, do not buy in India. I'm taking advantage of imbalance. Ideally, they should match. So this PPP is also called as law of one price. PPP is also called as law of one price. Ideally, the prices of all commodities must be ideally, theoretically same. If they are not, we can take advantage of imbalance. Same thing, interest rate, IRP. That suppose if I invest in Germany and then I get back the money with interest, and I invest in India, after 3 months I get the money back. Ideally, they should be same. But if the interest rates are in imbalance, then chances are it is better to invest in Germany than to invest in India because of foreign currency fluctuations. So whenever such imbalances are identified, we can take help of arbitrage profits. Another area of arbitrage is cross rates. Okay, another advantage of arbitrage is you can take the advantage using cross rates. Okay, means for example, okay, let us take for example, suppose you are given that 1 euro is equal to rupees 110 and $1 is equal to rupees 95. So ideally 1 euro, okay, ideally 1 euro should be $1.1578 ideally. In the real or in the theoretical world, if 1 pound is rupees 110, $1 is rupees 95, then ideally 1 euro should be this. But actually $1 was something different. Actually $1 was rupees, sorry, $1 euro was actually $1 1.20. So ideally it should be 1.15, but actually it is different. It may be less or more, but different. The moment it is different, that gives rise to arbitrage opportunity. Okay, so such kind of questions may also be asked in IRP, in which country we should invest. And in case of cross rates, you have to do the cross rates to make sure that you get more money out of it. So such questions we'll be solving obviously in a later time. Means later time as in just some moment. All the theory part is covered. Now we go to the numerical part, and there we understand all the questions we'll solve. Okay, MCQs you already solved. Okay, so we'll solve the big ones. And again, you're following it, you're understanding it. So please spread the love, like, comment, subscribe, share, and make the most of it. Okay, so let us go to the practical now. Let us go to the practical solving part. Chaliye, let us start. Yes, so now once we have done the theoretical concepts, now let us solve certain examples, okay, of different variety, so that we understand how the questions may be asked and how to tackle those questions. So initially we'll solve some basic examples, and then we'll also solve the previous year questions. Okay, let us start. So first example is calculate the arbitrage gains possible on rupees 20 lakh from the middle rates given below. Assume there are no transaction cost. So in the theoretical part, we discussed the concept of arbitrage. So arbitrage may come up in the case of interest rate parity, or in the case of purchasing power, and in the case of cross rates. So this question is given related to cross rates. If you can see here, you are given three rates. So first rate is rupees 120 is equal to 1 pound. So this rate is GBP, that is pound to rupees. Second rate is $1 is equal to rupees 90. So second rate related to dollar to rupees, and the third rate is related to pound to dollars. Okay, so first thing we have to identify that whether arbitrage is possible. Okay, what is the meaning of arbitrage? Arbitrage means a profit possibility because of imbalance in the rates or imbalance in the market. If there is perfect balance, then there is no arbitrage. So arbitrage, the origin of arbitrage is there is some mismatch, and because of that mismatch we can take advantage, we can earn a profit because of arbitrage. Okay, so now let us first check. So what rate they have given is, okay, so I'm just putting in this side. So 1 pound they have given is rupees 120. Okay, so I can write this as pound upon rupees is equal to 120 upon 1. Then I can write here dollar. So dollar upon rupees is 90 upon 1, and therefore comparing both of them, okay, comparing both of them, we get the rate 1 pound is equal to 120 upon 1 into 1 upon 90. So pound upon dollar, this is what they have given. So this is what we will compare. So pound upon dollar comes to this. So simple calculation, 120 divided by 90, so it comes to 1.33. So 1 pound is equal to dollar 1.33. Okay, so this is the ideal rate. Okay, this is the ideal rate between pound and dollars, and the actual rate is given here. This is the actual rate. So actual rate is 1.40. So ideal rate is 1.33, so it should be 1.33. Actually it is 1.40. So there is a mismatch. Okay, and if there is a mismatch, there is a chance of arbitrage. So this is the first step. We identify that what should be the rate. So in this example, the rate should be 1.33. Actual rate given is 1.40. Okay, and now we go on to find out that is there any possibility. Okay, is there any possibility of any arbitrage gains? Chali. So the person has 20 lakh rupees available. So what we are going to do, we are going to go from one currency to the other currency, second to the third, and third back to the original. Okay, so let us start now. Step number 1. Okay, step number 1, convert rupees 20 lakh which we have into pounds. Okay, let us convert this into pounds. So 20 lakh, this is the rate we are going to use. 1 pound is equal to rupees 120. So 20 lakh and conversion into pounds. Okay, so 20 lakh divided by 120, and therefore what is the money available with us? Available will be pounds 16,666.66. So we have used this rate. So 1 pound is rupees 120. Okay, so 20 lakh rupees will be how much? Simpler, 20 lakh divided by 120. So we got this. Then step 2. Okay, then step 2, let us see what is step 2. So step 2 is convert these pounds into dollars. Okay, convert these pounds into dollars again at the actual rate. So how many pounds we have? 16,666. These many pounds we have. We have to convert into dollars. So after conversion, we will get dollars, and that is 23,333.33. So we use this rate. If 1 pound is $1.4, so 16,000 pounds will be 16,000 multiplied by 1.40. So we got this amount. And the last step now, step number 3, convert these dollars into rupees. We started with rupees, so we end with rupees. So amount available, again the rate which you are going to use, actual rate. So rate is $1, rupees 90. So if $1 is 90 rupees, $23,000 is 23,000 into 90 rupees. So available rupees, when we multiply, we get 21 lakh rupees. Okay, we get 21 lakh. It comes to 20 lakh 9999. So round off to 21 lakh. And therefore now if you observe that we started with amount of 20 lakh. We started with 20 lakh, and now how much we have at the end of the day? We have 21 lakh. And therefore the arbitrage gains, will be 21 lakh minus 20 lakh. So arbitrage gains, that is arbitrage profit, is rupees 1 lakh. So how did we get the profit, or rather why did we get the profit? Because there was a imbalance. The ideal rate should have been 1.33, the actual rate is 1.40, and therefore we took advantage of this mismatch and we got the additional benefit. Okay, so this is a basic simple example to understand the concept that how an imbalance can be identified and how to take advantage of the imbalance. Okay, so this is the first practice question. Now let us go ahead. Let us see the next practice question. Okay, an American FPI, that is foreign portfolio investor, created a portfolio of rupees 95 lakh on the Bombay Stock Exchange. Okay, in the theory part we saw that foreign investors, they come to India to take advantage of our capital market. Then the exchange rate was at that time 95 rupees. Okay, exchange rate was 95. The beta of the portfolio is 1.25. So here there is a combination of the portfolio concepts, beta. Okay, so it's a combination of two concepts. One is currency, one is portfolio. At the end of the year, Sensex appreciated. Sensex increased by 20%. However, the US currency depreciated against the rupee by 3. So Sensex went up, but the dollar fell against the rupee. The investor decided to withdraw his investment from India. What would be his percentage returns? What is ROI in dollar terms? Okay, what is his returns in case of dollars? Okay, chaliye, now let us see how to solve this. Chalo. So now first of all, he created a portfolio of 95 lakh. So I'll write down, so portfolio value is rupees 95 lakh. And what was the spot rate then when he came to India? So spot rate at that point was rupees 95 per dollar. It is given in the question itself. The exchange rate was $1 rupees 95. So therefore, what was his investment in dollar terms? See, finally we want the answer in dollar terms. Okay, so 95 lakh, simple, divided by 95. So what amount he brought into India? He brought $1 lakh. The FPI, he brought $1 lakh into India, converted using 95, and that's how his portfolio became 95 lakh. So this is the starting point to identify how much dollars he brought into India. So this is step 1. Okay. Then what happened is the beta of the portfolio is 1.25. Okay, at the end of the year, Sensex appreciated by 20%. Okay, nice. Now let us use the beta concept here. So what is the meaning of beta? So beta is the returns. So returns of investor, whatever the returns change, okay, change in returns of investor upon change in returns of the market. Change in the returns of the market. This is the formula of beta. Okay, this is the formula of beta. Let us take this further below. Okay. So now beta value is given 1.25 is equal to what is the change of investor? This we don't know, but change in the market we know. The market has appreciated by 20%. Market has gone up by 20%. So using the concept simple cross multiplication, if the market has gone up by 20% and the beta is 1.25, so what will be the rise in investors portfolio, and therefore the change in investors portfolio. Okay, what is the change in investors portfolio? Simple cross multiplication, 20 into 1.25. So investors portfolio increased by 25%. A cross multiplication. This is the concept of beta. Beta helps you to identify the change in investor portfolio upon change in market. Okay, so second step is done. So his investment in India has gone up by 25%. So what was his original investment? His original investment was 95 lakh. And this 95 lakh portfolio has gone up by 25%. Okay, has gone up by 25% because of the beta concept. So 95 lakh was the original plus 25%, and therefore the value of portfolio, is now 95 lakh was the original plus 25%, so it has become 1 crore 18 lakh 75,000. The value of his portfolio is 1 crore 18 lakh 75,000. This is the next step. Now the investor said, now I am going back. I want to sell my portfolio in India, convert into dollars and I want to go back. Okay, but then what happened is, okay, till that time the US currency has depreciated against the rupee, okay, by 3 rupees, and therefore the exchange rate at maturity, I will say, that when he decided to sell the investment, the exchange rate, originally it was 95, the original rate at the time was 95, and now the question says that dollar has depreciated, rupee has become strong by 3 rupees. This is another test. So depreciation of the dollar. So if dollar has depreciated, means rupee has become strong. That means for the same dollar, you will have to pay less rupees. So earlier was 95 and less, rupee strong, so 92. So exchange rate has become 92, and now he will convert. So now let us see his investment value. Now we are going to get in dollars. So his investment value will be rupees 1 crore 18 lakh 75,000. This is rupees multiplied by the exchange rate, that is 92. So his investment value in dollars, his investment value in dollars, okay, it comes to okay, investment value in dollars, it comes to, let us see, 1,29,076 approximately. 129,076. That is the value of his portfolio. So originally he brought 1 lakh. Okay, originally he brought 1 lakh, and now that 1 lakh has become 129. So what is the ROI in dollars? Simple, on 1 lakh he earned 29,000 extra. So ROI, return on investment in dollar terms. Okay, return on investment in dollar terms will be 1,29,076 minus original investment, that is 1 lakh, upon original investment 1 lakh, and multiplied by 100. So final answer 29.076%. Final answer 29.076%. This is his ROI in percentage terms considering dollars. Okay, so we have solved in steps. So step 1, we identified what was his money which he brought into India in dollars. So that is 1 lakh. Second, we use the beta concept to identify if market has gone up by 20, our portfolio will go up by more than 20. Why? Beta is more than 1. So we use the formula of beta. We got that investors' portfolio will rise by 25. Then third step, his original portfolio was 95 lakh. It will go up by 25%, and therefore it will become 118. That is 1 crore 18 lakh 75,000. Then next step, the dollar also fluctuated. Dollar became weak. So 95 was the original rate. Dollar is weak. It will become 92. And last step, we reconverted the rupees into dollars, and we got the answer 1,29,000. So 1 lakh he brought, and 129 he is taking back. So how much extra? 29,000 odd, 0.76 extra. And therefore ROI, what is his percentage profit? 29.076%. Okay, so this is our entire journey from investment to change to profit to again go back to dollar, and that's it. So that is the next question. Okay, so first was based on cross rates. Now this is based on dollar appreciation, depreciation, and how the money changes. Okay, let us go to the next question. Now the next question is based on interest rate parity. Okay, the next question is based on, let us see now. Currently the US dollar is trading in India at rupees 95.50. This is the spot rate. If the 6-month interest rate in India is 10% per annum and USA is 4% per annum. So you are given spot rate, you are given interest rate in India, you are given interest rate in US. And first question they are asking whether the dollar will be at a premium or at a discount in the Indian Forex market. So here they are asking about the forward rate. So whether in the forward market, whether the dollar will be at a premium or a discount. Now you will say that, sir, how will we know unless we calculate? So, but that is the best part of the interest rate parity theory, that even without calculation, you can always tell which direction the dollar is going to move. In fact, that is the whole reason the IRP theory was created, to identify the direction of the forward rates. Okay, so what does the IRP theory say? First answer, what does the IRP theory say? So IRP theory says that the country with higher interest rate, its currency will fall in the forward market. That is the proposition, that is the main point of the IRP theory, that the country whose interest rate is higher, its currency will fall. So we can also write this in the other manner. Okay, we can say in other words, a country with lower interest rate, its currency will rise. Rise means appreciate in the forward market. This is the main statement of IRP theory. The country having lower interest rate, its currency will be higher, and higher means premium. And therefore, without solving the answer, we got the first answer, whether the dollar will be at a premium or a discount. See, dollar is 4%, USA rate is 4% and India rate is 10%. So India obviously higher, USA is lower. So where country has a lower interest rate, the currency will be at a premium. And therefore, the answer to the first question, A, the US dollar will be at a premium. We have not done any calculation yet, but just the theory, the knowledge of the theory IRP tells us the answer. Okay, so answer A is done. Now the second question they are saying, find out the rate. Okay, find out the rate. Now we already know that if spot rate is 95.5, okay, if spot rate is 95.5, this has to be more than 95.5. This we already know. So the second answer, now we have to write the formula of IRP. 1 plus RD upon 1 plus RF is equal to forward rate upon spot rate. This is the formula of IRP. 1 plus RD plus 1 plus RF is equal to forward upon spot. So what is RD? Domestic India, but it is 10%, but 6 months. Duration is, don't forget, 6 by 12. So 1 plus 10% into 6 by 12 upon 1 plus RF, RF is USA, 4% into 6 by 12 is equal to forward rate, which we have to find out. Spot rate is available, 95.50. Spot rate available. So now we just have to do the calculations. Okay, so let us solve. So numerator is 10% and 6 by 12. So 10% into 6 by 12 and plus 1, so 1.05. So numerator is 1.05, denominator is 1.02. 6 by 12 is equal to forward rate upon spot is 95.50. So now simply cross multiply 95.50 this into this divided by 1.02. Okay, so solving the equation, we get the answer of forward rate. So forward rate is $1 is equal to rupees 98.31. It comes to 308. Now since they have given two decimals earlier, we take two decimals, so 98.31. And we always knew that this is going to be at a premium. We always knew it will be more than 95.5. So by solving the answer, we got the forward rate using IRP 98.31 per dollar. So this is the answer of B part. Now C part, what will be the rate of forward, premium or discount? So rate, so they want the percentage of premium. We got the rate 98.31. Now they want the answer in percentages. Okay, they want the answer in percentages. So let us solve in percentages, no problem. Let us solve in percentages. So the third answer, so premium, yes, we know it is already at a premium. So premium percentage, what is the formula? Formula is forward rate minus spot rate upon spot rate into 100 into 12 upon n. N is the actual duration. So forward rate we already have 98.31 minus spot rate 95.50 upon spot rate 95.50 into percentage into duration is 6 months. Okay, so let us solve 98.31 minus 95.5 divided by 95.5 into 100 into 12 upon 6. So final answer 5.88%. So this is the premium percentage. End of the question. So first they asked us what will be the forward rate, premium or discount using IRP. So just the concept of IRP tells us that the country where interest rates are less, that currency will be stronger. So in the given example, the interest rate of USA was less, so US dollar will be at a premium. Then we use the formula of IRP to find out, and we got the answer that yes, it is 98.3. Then we found out what is the percentage using the formula of premium percentage, forward minus spot upon spot into 100 into duration. So we used that formula and got the third answer, that is 5.88%. Okay, so this is based on IRP. Okay, so this is also done. Let us go ahead to the next question. Let us go ahead to the next question. Okay, the next question. The spot exchange rate is 110 rupees per euro and the 3-month forward rate is 115 per euro. The 3-month interest rate in India is 8% and in Germany is 5%. Assume that you can borrow rupees 110 lakh. So right now that much funding is available here. Determine whether interest rate parity is currently holding. So they are asking us that whether the interest rates and the, see now they have given both interest rates of both countries, they have given spot rate as well as forward rate. So what they are asking is whether interest rate parity is holding. That means are the rates and the foreign currency interest rate, forex rates, are they matching? That is the first question they are asking. And second question, how would you carry out covered arbitrage? Okay, now the second question, if they are saying how will you do arbitrage, that itself is a hint that IRP is not matching. But we'll still have to show them that whether IRP is matching or not, and then we have to show the steps that how we are going to take advantage of the imbalance. Okay, so first IRP. What is the formula of IRP? 1 plus RD upon 1 plus RF is equal to forward rate upon spot rate. So what is the rate in India? 8% but 3 months. So 1 plus 8%, 3 by 12 upon 1 plus foreign country 5%, 3 by 12. This should match. Okay, this should match with forward rate, which is 115, upon spot rate, which is 110. So if both the sides match, then there is parity. If it doesn't match, then there is nothing. Imbalance, simple. Okay, so 8% into 3 by 12. Okay, so what is the numerator? So numerator is 1.02. Okay, I'll write down here. Numerator comes to 1.02. Upon denominator, 5% into 3 by 12. So denominator is 1.0125, and this we have to check whether they are matching. 115 divided by 110, this should match. Whether this is 1.045. So 1.02 divided by 1.0125, it comes to 1.007, and therefore they are not matching. Okay, they are not matching. So the first answer we got, hence there is no interest rate parity. Okay, so we tested that these two equations should match. Okay, but this and this, they are not matching, they are not the same, and therefore it does not match. It does not hold. IRP doesn't hold. That means it doesn't hold means that there is a imbalance. And now they're saying how you carry out a covered interest rate arbitrage. Now covered and naked, there are two types of strategies. Okay, covered strategies, I have the funds, I have the stocks, I have the currency, and then I'm entering into a contract. That means there is a backup. That is called as a covered strategy. And the naked strategy is I don't have a backup, but I still enter into a contract that later on I will do something. Later on I'll get it. Right now I don't have. So when you do not have the asset and then you promise to buy or sell, you don't have the money you promise to buy, you don't have the asset you promise to sell, that is called as naked. But you have the asset and now you are promising to sell, that is called as a covered strategy. Okay, so here they are asking us that what are the steps? Okay, what are the steps of earning arbitrage profits? Okay, let us start now. Step 1. Step 1 is borrow rupees in India, and I already said that borrowing is available of 110 lakh rupees. This is the borrowing available, and obviously it's not free, it is at 8% per annum. So borrow in India for 3 months. Step 1, rupees 110 lakh at 8% per annum for 3 months. Step 2, convert the loan amount into euro at the spot rate, that is today. Okay, convert this loan into euro at the spot rate. Now, what is the spot rate given? Spot rate is given rupees 110 per euro. Okay, 110 per euro, and therefore amount in euro will be 110 lakh rupees upon exchange rate 110 rupees per euro. This is the exchange rate. So how much euro I will get? Simple, 1 lakh euro. 110 lakh upon 110, easy. Okay, so how much money I have in euro is 110 divided by this. So 1 lakh euro I have. Step 3, invest this 1 lakh euro in Germany at 5% for 3 months. Their rate is 5% and duration is matching duration, loan for 3 months, investment for 3 months. And therefore, you will get interest on this 1 lakh into 5% into 3 by 12. So you will get interest of euro 1250, and therefore total amount you will get principal plus interest. So total amount at maturity is euro 101250, principal plus interest. So at maturity you will get this amount. That is step 3. Then step 4, come back to India. Step 4 is convert this euro into rupees at forward rate. Forward rate means at maturity, means after 3 months you come back to India with this amount, and therefore amount in rupees is equal to 101250 multiplied by the forward rate, and forward rate is 115. And therefore what is the funds you have? Funds available in rupees 116 lakh 43,750 rupees. This is what you will get. This is your inflow after converting euro into rupees. This is your inflow. But now remember, we had taken a loan, so you have to repay the loan. So let's repay the loan. Step 5. Repay the loan with interest. Repay the loan with interest. So the interest in India is 8%. Okay, so interest will be 110 lakh multiplied by 8% into 3 by 12. So 110 lakh into 8% into 3 by 12. So your interest amount is 2,20,000 rupees. So total outflow, principal plus interest. So total outflow, loan plus interest. Total outflow is rupees 112 lakh 20,000. Okay, so inflow is this and outflow is this. So final step, step 6. Arbitrage gains inflow minus outflow. So inflow is 116,43,750 minus outflow 112 lakh 20,000, and therefore there is a gain of 4,23,750 rupees. This is a gain, end of the answer. So here we have done a arbitrage calculation using interest rates. In the earlier question we did arbitrage using cross currencies, and here we borrowed in one country, invested in the other country, again came back, repaid the loan, but still we have an extra amount left, and that extra amount was because of the arbitrage gains. Okay, so this is the question on interest rates using arbitrage. Now let us go ahead. Okay. Yes, so now let us solve some exam questions. Okay, let us solve some PYQs, past exam questions. So to have an idea that how different questions were asked, okay, and then how to go about those solutions step by step. Okay, so let us see here. Now we are in June of 2023. A company has imported goods of 1 crore US dollars. The payment terms are 60 days interest free. That means the foreign supplier is allowing 60 days to pay the money. For additional 30 days credit interest, the foreign supplier is charging interest at 7.75% per annum. So basically what is the situation? If I am the importer and I am asking the supplier for 90 days credit, supplier says 60 days I will give you free of cost. Okay, but for the remaining extra 30 days you have to pay me an interest of 7.75% per annum. So then second option is the company can take a loan here. The company has a choice of taking a loan in India to pay the foreign supplier, but the rate of interest in India is 7.5%, which seems to be on the higher side. But the difference is the interest rate for the supplier is in dollars, and the interest rate on the Indian loan is on rupees. So that we have to check. And then you are given the spot rate. Okay, you are given the 60-day forward rate. Why 60 days is given? Because till 60 days there is no payment to be done. So 60 days is free period. So the whole thing is either you will pay on 60 days or you will pay on 90 days. Therefore 60 and 90 are given. And what is asked is advise which of the following options would be better for the company. Option 1, pay the supplier on 68th day by taking a bank loan. So option 1 is take a loan in India and pay the supplier. Option 2, pay the supplier only after 90 days. No loan, pay him interest. So consider 360 days and calculation in crores, rounding off to 4 decimal points. So keep the calculation in crores, they are saying, and for 4 decimal points for rupees and 5 decimal points for dollars. Okay. So what is the question? Question is about an importer and he has to make a choice either to pay by taking a loan or to pay directly by giving the interest to the supplier. And since we have to pay, it's an outflow. So what does common sense say? Whichever lower is better. When you have to pay money, lower the better. We have to receive money, higher the better. Okay. Shali. So let us start with what all information is given. So whenever you have to start such an answer, you always start with the given information. Okay, so what is the given information here? The given information is we are an importer, and what is the invoice value? The invoice value is US dollar 1 crore. Okay, then we have a interest free period. Interest free period is 60 days. Okay, interest free period is 60 days, and therefore the additional period, the interest is on the additional period. So additional period is 30 days. So the interest calculation will be for 30-day duration. Okay, so first is option 1. So option 1 is bank loan. Option 1 is bank loan, and the rate of interest on bank loan is 9.50% per annum. Okay, so now bank loan we have to take. So loan we have to take in that fashion, that amount, that it is $1 crore, but when we have to take a loan? After 60 days. So 60 days forward rate we have to start with. Do not take the spot rate because we are not taking the loan today. 60 days are free period, no interest, full credit. So the loan will be after 60 days. So 60 days forward rate, it is given $1. Let us see what is the 60-day rate. $1 is 76.15. $1 is rupees 76.15, and therefore the loan amount will be 1 crore into 76.15. So loan amount is rupees, simple, 76.15 crores in rupees. Okay, because we have to pay their dollars. So if we borrow in India, so borrowing in India is in rupees 76.15. Now on this I have to pay interest. So interest at 9.5% per annum. So 76.15 into 9.5% for 30 days. They have said take 360 days for calculations. Okay, 360 days for calculations. So let us do 76.15 into 9.5% into 30 divided by 360. So what is the interest? Interest is 0.6028, okay, crores and rupees. So total how much we have to repay? So total outflow at maturity, that is loan plus interest. So loan is 76.15 plus interest is this. So total how much we have to repay? Total we have to repay is rupees 76.7528 crores. Total we have to repay principal, that is loan amount 76.15 plus, okay, loan amount plus interest. So interest is 0.6028 crores. Again rupees, you add both of them. So what is my outflow? My outflow is 76.7528 crore rupees. So if I choose the first option, okay, if I choose the first option, this is what will be my outflow. Now let us see the second option. Now if I choose the second option, okay, let us choose the second option. Option 2. Now what is the option 2? Option 2, let us see what is the option 2. Pay the supplier, that is no loan. Option 2 is pay the foreign supplier. After 90 days, that means we are going to give interest to the foreign supplier. Okay, so what is the invoice value? So invoice value is $1 crore. Then interest, so interest will be to the foreign supplier at 7.75%. 7.75% into 3 by 12. So 1 crore into 7.75% into 30 days. So 30 upon 360. Sorry, my bad. So it is into 30 days upon 360. So let us recalculate. 1 crore into 7.75% into 30 upon 360. So the interest amount will be in dollars 0.00645 crores. So total payable in dollars. So 1 crore is the invoice. So 1 crore plus interest. So total payable dollar 1.00645 crores. This we have to pay, but when? After 90 days. Okay, this we have to pay after 90 days. So we have to use the 90-day rate. So what is the 90-day rate? $1 is equal to rupees. What is the 90 day? 76. The 90-day rate is rupees 76.45, and therefore what is the cash outflow at 90 days? How much we have to pay? So this amount multiplied by 76.45. So it comes to where were we? 1.0645. Okay, multiplied by 76.45. So therefore we have to pay 76.9437 crore rupees. So if you had chosen the first option, this is what your outflow is. And if you are choosing the second option, then second option, this is what your outflow is. So you have to compare both of them. We have to compare this 76.75 and the second one is 70. Okay, so this option looks better. So after comparison, okay, if you compare these two, okay, if you compare these two, then obviously this option looks cheaper because finally it's outflow. So 75.75 and here is 75.94. Okay, so conclusion, option 1 should be selected because there is savings. Take the difference of both, savings of approximately 0.1903 crores. So approximately 19 lakh saving if you choose option 1. So in international transactions, okay, the savings are also huge. So here you might say 0.19, but that 0.19 is in crores. Okay, 0.19 is in crores. So when we convert it, it becomes 19 lakh rupees of savings. Okay, so that is the end of the answer, and easy. You just go through the steps. What steps are given, what the question says, you follow, and then you solve. Okay, let us take the next question. B part. The company is an American company under an obligation to pay interest. Okay, they have to pay interest in Canadian dollars. CAN is Canadian dollars 10,10,000 and Canadian dollars 7,05,000 in July and September. So they have to pay interest in that currency. The company is risk averse and they want to hedge the risk. Okay, finance manager is thinking of hedging two methods, either forward rate or option contract. So this question is a combination of forex and derivatives, options contract, forward contract. it is now June today, and following rates are given, and first data is given: spot rate 1 month forward, 3 month forward. Okay, and you are given the price. Price is the premium. This is the premium. Cents. Now cents means in India we call it rupee and paise. Correct? There it is dollar and cents. So $1 will be 100 cents. Like here 1 rupee is 100 paise. Same thing. Then lot size for options contract, lot size is given $50,000, and the call option given, put option given to confuse us. But remember who we are. Right? Who we are. That will decide which option to be taken. So they have to pay interest. You have to pay interest, and payment means similar to an importer. So whenever it comes to payment, then we always choose the call options. We always choose the call options. Okay. So call options are given, strike prices are given for July, September, and according to the suggestion, if the options are used, 1 month should be, because they have to make a payment twice. One is after 1 month and one is after 3 months. So for 1 month strike price, this will be used. This is what they are telling us. And for 3 months, they will use this one. Okay, so this is one data we have to pick up for 1 month, and this is the second premium we have to pick up for 3 months. And the remainder uncovered by the options. Now why uncovered? Because there is a lot size. Okay, I'll tell you how it is to be done. So there's a lot size, and therefore there will be some dollars which do not fit in that contract. Those dollars will be taken using forward rate, and recommend which two methods are the best ones. Okay, so now this question looks a lot complicated. Okay, honestly speaking, if I'm thinking from a student point of view, a student looks at the question and he's like, I'm lost. Still, see, the earlier question was easy, so there we can score maximum marks. Okay, 6 out of 7, 7 out of 7, 8 out of 8, whatever the marks are. And in this question, yes, it is slightly lengthy and confusing, and options, there are a lot of data given. But even if we are stuck, the one thing we can do is we can still solve forward. So when options are a problem, we can still solve the forward thing. So at least not 7 out of 7, but we'll at least get 3 out of 7. So instead of not trying at all, okay, options you can maybe put for option, and at least forward thing you can do, because forwards are easy, simple. So that we can always plan. Okay, so let us see now data. So this is 10,10,000 in 1 month and 7,05,000 in 3 months. So forward rate, this is 1 month forward, this is 3 month forward. Okay, Canadian dollar and 1 month forward rate, US dollar per Canadian dollar. So 1 CAD is equal to these rules as are given. Shall let us solve step by step. Okay, so this is now question 7B. Okay, 7B. So alternative 1. So alternative 1 is forward rate. Okay, alternative 1 is forward rate. Now what is the information given? Now in the 1 month, how much they have to pay? Okay, they have to pay Canadian dollars 10,10,000. Okay, in 1 month they have to pay this rate. And what is the forward rate? Okay, forward rate is given 1 CAD is equal to USD. So forward rate is 1 Canadian dollar is equal to US dollar. In case of forward market, 0.9301, and therefore amount payable Okay, let us see amount payable. Okay, so the rate is given 1 Canadian dollar is equal to USD 0.9301. So total we have, okay, total we have 10 lakh 10,000 into 0.9301. So how much we are supposed to pay? So amount payable in US dollars, that is 939,401. This is for the forward rate for 1 month. Now if you consider the forward rate, the same thing for 3-month payment also, we have to pay twice, 1 month and 3 month. So for 3 month we have to pay 705 Canadian dollars, and the 3-month forward rate is also given. 1 CAD is equal to US dollar 0.9356. So 705 multiplied by 0.9356. So how much we have to pay? So amount payable in USD. Amount payable in USD is 659,598 dollars. Okay, so this is the option 1. See, that's it, finished. Option 1 is that easy. Means I was telling you that sometimes the question looks very complicated and it is big, okay, but there is always a part which is manageable. So in this question, even if I solve this much and I go ahead to the next question because I was confused in the option, but at least whatever I have solved is correct. So the paper checker will give you, okay, 2 out of 7 or 3 out of 7 for this working. And that will obviously help in going towards our exemption. Okay, so option 1 is done. Forward rates. Now option 2. Okay, now option 2 is, or alternative 2, I'll use the word now. So alternative 2 is options contract. So options contract also we have to do separate for 1 month and separate for 3 months. So first we'll take the first month, that is July. So July is 1 month. So July the rate is given. Okay, so what is the rate of July? July option contract. See here, option contract July strike price is 0.94 and premium, this is the premium amount. So premium is 1.02. So we have to consider both. Okay, we have to consider both. So for options contract, first of all, okay, for options contract it is in lots. Okay, it is in lots and lots are of 50,000. Now in July, how much amount we have to pay? In July we have to pay 10 lakh 10,000. In July we have to pay 10 lakh 10,000, and in September we have to pay 7 lakh 5,000. This is the amount payable, but the lot size is 50,000. They have given in the question. Let us see here. See, the lot size is 50,000 Canadian dollars. And therefore number of contracts is 10 lakh 10,000 divided by 50,000. It comes to 20.20, and in the other case it comes to 14.10. Now we all know that the contracts are not in decimals, it's the entire amount. So here in the first case this 20 cannot be a part, and here also this 10 cannot be a part, because Option contracts are in full values. They are never in decimals. It's 5 contracts, 6 contracts, 7 contracts, 20 contracts, 15 contracts. It's never 20.2. It's never 14.1. So that balance, okay, that we have to remove. And therefore, that balance is this 10,000 extra wala. And therefore, for the July thing, for the July payment, that 10,000 we have to consider separately. Here only 10 lakh. And for September, that 7 lakh 5,000. 5,000 we have to take it separately, only 7,000, so that the entire contract is complete. So if you do 10 lakh upon 50,000, then 20 contracts. Okay. And strike price now. Strike price is given 0.94 in this case, and in this case the strike price is given 0.95. So amount payable, first part, amount payable 10 lakh into 0.94, so USD, US dollar, 9 lakh 40,000 in this case, and 7 lakh into 0.95, so amount payable 6 lakh 65,000 US dollar. This is the first part. Okay. Now we also have to pay the premium. Okay, so what are the premium given? The premiums are given 1.02, but that is in cent. So second thing we have to pay is we have to pay the premium. Okay, we have to pay the premium. So premium is given here. So premium is this for July 1.02, and here 1.64. But remember, these are cents. Okay, these are cents. It's a paise, rupee, cent and dollar. So this is not per dollar, it is per cent. So what is the calculation of premium? Premium is 10 lakh into 1.02. But 1.02 is not per dollar. Okay. So upon 100. So 10 lakh into 1.02 divided by 100. And therefore, how much premium you are paying here? You are paying 10,200 premium. Similarly, you have to pay premium here. So here it is 10 lakh. 10 lakh from where? Here. So here it is 7 lakh. Option contract is on 7 lakh. So 7 lakh into premium is 1.64. But it is not per dollar, it is per cent. And therefore, 7 lakh into 1.64 divided by 100. Okay, 1.64, yes. So it comes to 11,480. That is the premium on September. Now still the question is not finished, because the total payment was 10 lakh 10,000. But how much we have taken in options contract? Only 10 lakh because of the lot size. So what is the remaining 10,000? So remaining, what to do, they have mentioned here. See here, the remainder has to be taken using the forward rate. Okay, remainder has to be taken using the forward rate. So 0.93 and this. Okay. Now remainder. Now remainder is, I'll just write down here. So what remained? Remained are, in this case, 10,000 at forward rate. And forward rate we have seen above. Forward rate was this 9301. Okay. So 0.9301 into 10,000. Okay. So it comes to $9301. And similarly here also the remainder is, here it is 5,000 into the forward rate. So forward rate was 0.9356 into 5,000. So 4678. And now the total outflow. So total outflow for first month 9,40,000, that is 1 plus 2 10,200 plus 3 9301. So total US dollar you are paying 959,501. And in this case this is September, this is July, and this is September outflow. Okay, September outflow. So 665 plus 11,480 plus 4,678. So US dollar you are paying 6,81158, 6 lakh. And now this you have to compare with the forward rate. Now let us see what was the forward rate. Yes, so forward rate was 939 and 659, and here it is 959. So obviously savings. Okay, what are the savings? 959,501 and forward was 939,401. So savings of $20,100. Forward is better. What about here for September? Let us check for September. So September is 6,81158 at the options, and forward is 659,598. So here there is savings of 21,560. Again forward is better. So they have asked which is better in the final, which of the following two methods will be appropriate where they will be saving. So answer is forward. Forward should be selected because of less outflows. When it's come to payment, lower the outflow, better the option. Okay, so 2 questions from this examination. Now let us go to the next paper. Okay, so we go to the next paper. Now this we are solving is December 2023. So last was June 23 and now this is December 23. So company is an Indian MNC. Okay, and they're executing a plant in Nepal. It has raised 600 billion. Half of the amount will be required after 6 months. So basically they have to think about the balance 300 billion. The company is looking for an opportunity to invest this money for 6 months. It is considering 2 options. Okay, so option 1 is invest in the UK in their index fund. So you will receive dividend plus income from this, and at maturity chances are the value will fall by 3%, that is discount on investment value. Then exchange rate is given for conversion today, and 6-month rate is given for reconversion into rupees. So if I invest in UK, first convert rupee into pound plus all the benefits and then come back to rupees. Okay, we solved one example earlier today that foreign investor came to India, earned money, went back. So similar kind of sum. Second option is invest in Europe, treasury bills. So there is no dividend, nothing, just that you will have a interest of 7.8% per annum. Again, come back to your own currency, whichever or wherever you get a higher amount, because it's about receiving money. Wherever we have a higher amount, that will be chosen. So it looks a dangerous sum, actually it is not. Sometimes you have to stay with the question, just read the question calmly, quietly, to understand that it is not that difficult. So let us solve this question. So as I said, the topic is about the balance amount. Okay. So the total amount of the project. So total project is rupees 600. Total project amount is rupees 600 billion, out of which 50% is needed later on. So we are not talking of this, we are talking of 50% available right now for investment. So available is 50%, that is 300 billion. This is available for investment. Okay. So there are two options. So first option is invest. First option is invest in UK. Invest in England. That is the first option. So if you have to invest there, so first you have to convert into pounds. So for conversion into pounds, you are given the spot rate. So what is the spot rate given? 1 INR is equal to 0.099. Okay, so spot rate is given GBP, that is Great Britain pound, per INR, that is Indian rupees, 0.0099. Okay, so first 300 billion we have to convert into this. Okay, so amount invested in pound will be GBP, 300 multiplied by this amount, so it comes to 2.97 billion. So 300 billion and the rate is given, so multiply here, so you get 2.97 billion. So this is the amount which you are going to invest in UK. Then what are the gains? What are the different gains you are going to get? It is mentioned you are going to get dividends. So first benefit is dividend. So dividend is again in pounds, 0.1365. Then second benefit is from lending. Second benefit is from lending, that is also given 0.0065. Okay, and third, okay, third is at maturity. However, at maturity, this value which they have given 2.97, this will fall by 3%. They have given in the question that this amount invested will fall by 3%. So just simply minus 3%. So how much you are going to get at maturity? You are going to get 2.8809. So I invested 2.97, on which I got dividend. Okay, lending benefit, yes, and at maturity obviously I have to get the money back, but there was a 3% loss. There was a 3% loss which is given in the question. Hence, after 6 months, what is the amount received in pounds? Plus 0.1365 plus 0.0065. So total you have got is 3.0239. All these figures are in billions. Okay, all these figures are in billions. So you invested 2.97 with dividend, everything add less. This is the amount you received, and now you are going to convert this back to rupees. So what is the forward rate at 6 months? Given here, forward rate at 6 months is 0.100. So forward rate 0.0100, and therefore received how much now? Rupees. How much you have received? Let us see. You have received 302. You invested 300 billion and you are back with 302.39 billion rupees. You are back with this amount, and therefore there is a gain 300 and difference, so there is a gain. So this amount minus 300 you invested, so gain of 2.39 billion rupees. So if you invest in UK, this is what you are going to get. Now let us see the second alternative. The second alternative is invest in Europe. Okay, second alternative is invest in the treasury bills in Europe. So now if you have to go to Europe, then you have to go into their currency, that is euro. So that spot rate is also given. So spot rate, okay, spot rate is euro to rupees is given 0.0110, and amount is same 300 billion. So 300 into 0.0110. So amount invested in euro, is 3.30 billion. Okay, amount invested there is 3.30 billion. And now what are the gains? So here there is no dividend. There is no dividend. Then there is no lending. Nothing is given, nil. But here there is interest. There is interest given at 7.8%. So 3.3 into 7.8% for 6 months. So interest you will get euro 0.1287 billion. Interest will be given to you. There is no dividend, no other benefit, simply this. Okay, simply this. And because treasury bill is risk free, okay, treasury bill is risk free, so on maturity the full amount will be back. What was the amount? 3.3. So 3.30 will be billion, will be back as it is. So what is the amount received in euro terms? What is the amount received in euro terms? It is 3. Okay, it is 3.4287. Simply add these two. So interest plus maturity amount. But then you have to convert it. So 6-month exchange rate that is given to you. 6-month exchange rate, euro to rupees, this rate is given 0.011. Okay, 0.011, and therefore amount received now back to rupees. So our journey is now completed. We are now back to rupees. Okay, this divided by 0.011. So 311.70 billion rupees. So we invested 300 and we are back with 311. So there is a gain of 11.7 billion. So now you have both the amounts in front of you. So if you invested in England, your gain is 2.39. What you invested in Europe, your gain is 11.70. So the clear winner is invest in Europe. Okay, so that's a comparison. So now once you see the solution, you see the step by step, you realize it is not that difficult at all. Just that the institute will design the question in such a fashion that it seems tough. But in reality, you just have to spend more time. We say now that if you want to have a good positive relationship, just spend more time with that. Either it's a question or it's a person. So same thing here, spend some time with it, okay, and have some patience and you will get everything, and that's why we are practicing. So you have some ideas that what should be your point of view, what should be your steps, how you should go about when thinking. Okay, so that was the question 7A. Now same paper, let us solve 7B. Okay, same paper 7B. A company is an export oriented unit, okay, invoices in currencies of the other country. It is expecting to get 2,40,000. So this is the receipt they are expecting on 1st of August for the goods exported on 1st May. So today is May, so May, June, July, 3 months duration. Following information is available on 1st May. Contract size, this is for the futures contract, okay. Then exchange rate, spot rate, 1 month forward, 3 month forward, and currency futures, May futures and June. And if it is futures, then we know that there is initial margin you have to pay. So initial margin, it's a deposit you have to pay. And these interest rates are given because since you pay deposit, your money is blocked. So on that blocked money, there is opportunity loss. So interest rates are given to calculate the opportunity loss on margin money. And on 1st August, the actual spot rate. So this is the actual spot rate at maturity is this, and the currency future rate is 0.0125. Okay, that is on maturity. So suggest a suitable approach for the company, most advantageous. So 3 alternatives. Number 1, what will happen if they take a forward rate, what will happen if currency rate, and what will happen is no hedge. So no hedge is do nothing. So do nothing means you just pay or receive at the actual rate. So no hedge is also called as keep the exposure open. That is another way of saying that don't do anything. So the technical way of saying is keep the exposure open. Okay, so let us solve. First is forward. So forward is for 3 months. So May, June, July. So 3 months forward rate. So we have to take this one. Okay. Okay, so export value. So export value is $2,40,000. This is common for all the situations. Situation 1 is forward rate. So duration is 3 months. So we have to take a 3-month forward rate, and 3-month forward rate is given 0.0123 dollar per rupee, 0.0123 straight away, and therefore amount receivable, since it is export, so amount is receivable. So 2,40,000, that is dollars, and we have to rupees, so divided by 0.0123. So amount receivable rupees 1,95,121,95. So basically 195 lakh 12,195 rupees. So out of the 3 alternatives, 1 alternative is done. So if a question is 3 marks, you already got 2 marks. So sometimes even if a tough question, but there is always a easier part which you can always solve and get the marks. Second is go for a futures contract. Okay, second is go for a futures contract. Now let us see futures contract. Yes, futures contract are given on this side. So dollar May contract, right now we are in May, 1st May. Okay, all the data is given on 1st May. So lot size, okay, this is the lot size. Each lot is 6,40,000. Okay, and May contract is for 0.0126 futures price, and June contract is 0.0125. Okay, on August, that is the due date, the spot rate, actual rate is 0.126, and currency future rate is 0.0125. All this information is given to us. All this information is given to us. Okay, chaliye, let us solve. So we are on 1st May. So we'll take the May contract. So futures contract. So May futures 0.0126. Therefore, contract value 2,40,000. Contract value 190 lakh 47,619. But lot size is rupees 6 lakh 40,000. So number of contracts. So number of contracts is simple division. You round it off 30. So how did I get number of contracts? This divided by this. The answer comes to 29.76. So we round it off because we cannot have a fraction or decimal contract. So we round off to 30 contracts. Now you are also given the initial margins. Okay, you are given the initial margin. So the contract is for August because our maturity is August. So 30 contracts we have taken and the initial margin is given. So initial margin is equal to 30 contracts into 26,000, that is for each. Okay, so 30 into 26,000. So initial margin you have paid rupees 7,80,000. Initial margin you have paid is 7,80,000. And therefore opportunity loss, that is why the interest rate is given, 7,80,000 multiplied by, what is the rate given, 8.5%. 8.5% and duration is 3 months. So into 8.5% into 3 by 12. So what is the money blocked because of this? Money blocked is 16,575. So indirectly this is your loss of interest. Okay, money blocked means this is your loss of interest. Okay, so now what the question says is, now see here, the spot rate at maturity is same as the forward rate. So spot rate is 0.0126 and the forward contract is also the same rate. The May contract was also 0.0126 and the maturity value is also 0.1. So there is nothing extra you are going to save. Okay, you are nothing extra you are going to save, but what you have done is you have, yes, what you have done is you have paid that interest loss. Okay, you have paid that interest loss, so that we have to adjust, and therefore net amount net amount receivable, your contract value, that is 190 lakh 47,619 minus your interest loss 16,575. This is the loss of interest. $16,575, and therefore the second option, net amount received 190 lakh 31,044. So this is the net receivable. This is the net receivable after second option, that is futures contract. First answer was this. This was the first 195. This is the second 192, and third alternative is no hedge. No hedge, also known as keep the exposure open, do nothing. Keep the exposure open means do nothing, and therefore invoice value $2,40,000, actual exchange rate at maturity is 0.0126, and therefore amount receivable, so 2,40,000 divided by 0.0126, so amount receivable is rupees 190 lakh 47,619. This is the third. Now you compare between 1, 2 and 3, and here it is receivable, so receivable higher the better, payable lower the better. So here option first alternative forward rate, we are getting 195 lakh, then 190 lakh, and again 190 lakh, and therefore alternative 1, that is forward rate, is the best. Forward rate is the best because there is maximum receivable amount. That is the end of the answer. 7 marks. So in this question also, again, that if I am attempting the question and I could do the forward rate, yes, and in futures I was confused, suppose in futures I was confused what to do, what not to do, but it's okay, you can still do the option 3. Option 3 is don't do anything, keep the exposure open. So out of 3 plans, and if you think the question is tough, out of 3 plans you're still doing 2 of them. That means out of 7 marks, still you will get 4 to 5 marks. Even though you thought the question is tough, still you are getting these many marks. So that's a good part. Okay, let us go to the next question paper. Okay, चलिए. So next paper देखते हैं यहाँ पे. The following 2 quotes appear in the foreign exchange market, and rupees per dollar. Okay, rupees per dollar rate दिया हुआ है. And what percentage has the dollar currency change? Analyze the nature of change and answer with reference to ask rate. Now the given information is given in a direct quote. How do you know? Because foreign currency dollar is kept as 1, rupee is fluctuating. So direct quote, so the rule is buy, that is bid low. So this will be the bid rate, this will be the ask rate. Similarly, this will be the bid rate, this will be the ask rate, because in case of direct quote, bid low, ask high. So the first question they have asked is, by what percentage the dollar has changed, and consider only ask rate. Okay, percentage change. Okay, percentage change in dollar terms. So let us see here. So first I'll write the rates. So 1 US dollar is equal to, I'll write all the rates. So 82.25, this is the bid rate, and rupees 82.50. So this is the bid rate, this is the ask rate. Okay, bid and ask, and these are spot rates. Now they have also given the forward rate for 3 months. So 3-month forward rates also let us write down. So $1 is equal to rupees 83.00 and rupees 83.50. This is the ask rate. So first question is, what are the changes with respect to dollar and ask rate? And they asked us to find out the percentage. They asked us to find out the percentage change. So formula is forward rate minus spot rate upon spot into 100 into 12 upon n. So duration is given here 3 months. Yes, 3 months. So we take months, 12. And since they have asked only ask rate, so we take only ask rate. So ask rates are 83.50 minus 82.50 upon 82.50 into 100 into 12 upon 3. So it comes to 4.85. First answer 4.85%. So answer to question number A is done. Now what is question number? So this is done. The second one, by what percentage the rupee will change? Analyze the change with respect to bid rate now. The earlier was ask rate and dollar terms. Now this is bid rate and rupee terms. So what I'm going to do is, I'm going to convert this direct quote into indirect quote. Why I'm doing that? Because they have asked in rupee terms. Yes, so remember this data was given direct quote, and now I'm going to convert it into indirect quote. So 1 rupee is equal to, how to convert? Simple, reciprocal. So 1 divided by 82.25. So 82.25. So 1 rupee is equal to $0.01216, and 82.5, the second rate is, that is ask rate, $0.01212, that is the ask rate for spot. This is spot, this is forward. Now 1 rupee is equal to, so 83, 1 divided by 83, so $0.01205, and on this side 83.5, so $0.01198. So what I have done, I have converted the direct quote into indirect quote. Why I have did this? Because they wanted the answer in rupee terms. Okay, they wanted the answer in rupee terms, and they also want for the bid rate. So bid rate is these are the bid rates. Okay, so again the same formula, percentage change is equal to forward minus spot. So what is the forward rate? Forward rate is this. So 0.01205 minus spot 0.01216 upon 0.01216 into 100 into 12 upon 3. So 0.01205 minus 0.0216 divided by 0.01216 into 100 into 12 upon 3. So it comes to 3.62, but it comes negative. So 3.62, it comes negative, and negative means discount. Okay, negative means discount. In the earlier case, answer was positive. Positive means premium. This we learned in the theory concepts, that the formula remains same. If the answer is plus, we say premium. If the answer is minus, we don't say minus, we say it is a discount. So B part is done. Now let us see what is the C part, third part. Okay, so this is also done. Assess how many US dollars should a firm sell to get 50 lakh after 3 months. So we want rupees. Okay, we want rupees after 3 months. Now see the wording again. So we have to identify which rate to be taken. How many rupees is the firm required to pay to obtain dollars? Sorry, I wrote the third one. Assess how many dollars should a firm sell to get 50 lakh rupees. I'm selling the dollars after 3 months. So if I'm selling the dollars, that means bank is buying the dollars. So investor is selling. Okay, investor is selling dollars to receive 50 lakh rupees. So if investor is selling the dollar, hence bid rate, because bank is buying the dollars after 3 months. So what is the 3 month? Let us see what is the 3 month bid rate. So 3 month bid rate is 83 rupees. 83 rupees. And therefore dollars needed is equal to 50 lakh rupees upon 83.00. So how many dollars are needed to get this? So answer is you require 60,240.96. So $60,240.96 are needed to get this amount. Then the fourth question, how many rupees is the firm required to pay to obtain US dollars 2,50,000 in the spot market? Now we want a dollar, so bank is going to sell the dollars. So we need US dollars, hence bank will sell, and sell means we have to take ask rate. And spot market, so spot market ask rate, spot market ask rate 82.50, and therefore how much dollars are there? $2,50,000 into the rate 82.50. So 82.50, 2,50,000. So how much rupees we have to give? We have to give 20 other 2062. So 206 lakh. 206 lakh. That is answer of D. Okay, that is answer of D. So we have to be very careful, bid rate and ask rate. And one more question they have asked. So this is done, this is done. Assume that a firm has $1 lakh in the current account today and return on rupee is 10%. Should the firm encash right now or they should wait? Okay. What the question is that they are saying, assume that you have $1 lakh today. If you encash it at spot rate, you invest it, or else you keep it in dollars and after 3 months you encash it at the forward rate. So let us see which is beneficial for us. So option 1, $1 lakh we have, so we will sell it to the bank at spot rate. But spot rate, which one you have to take? Bid rate, at spot bid 82.25. Why? Because we have dollars, we will give it to the bank, bank is buying dollars. So how much we will get immediately today? 1 lakh into 82.25. So we will get 82,25,000. This will receive today. Then this we will invest. They are saying investment at 10%. So 82,25,000 into 10% into 3 months. Into 3 months. So interest is 205,625. This is the interest. So how much total you are going to get at maturity? At maturity amount, principal plus interest. So this is the principal and this is the interest. So total you will get 84,30,625. This is what you will get at maturity if you convert now and invest for 3 months. Second option is you don't convert now and you convert after 3 months at the forward rate. So 3 month, again we have to take the bid rate. So 3 month bid rate is given rupees 83 per dollar, and you have $1 lakh, and therefore after 3 months how much amount you are going to receive? Rupees 83 lakh. 1 lakh into 83. But if you withdraw today, you invest, and then with interest you are getting 84. So what is the decision? Decision is option 1. Option 1 is convert today and invest. Convert today and invest. That is the best option. End of the question. Okay, end of the question. So all these are exam questions we are solving. So earlier we solved normal questions, now we are solving exam questions. Concepts are keep on coming. Now let's go to the next exam question. Okay, so now this is the latest paper, that is December 2025. Okay, so let us see what the question is all about. So company is an Indian healthcare company, has recently signed a contract to import. So first thing we have to identify is we are importers, and value is 8 million US dollars, duration 6 months. So these are the keywords which we have to keep in mind. Given the volatility, the CFO is concerned about the risk and they want to have alternate hedging strategies. So we have to compare 2-3 strategies, and since importer, so we have to pay less, that is the best. So spot rate is given rupees per dollar. Okay, then 6 month forward rate is given. Okay, then interest rates are given in India and USA. Fine. Then options are available. Option contract, 6 months call option, strike price and premium. And then probability given, because if you're talking about option contract, either this may happen or that may happen. Okay, so that also we have to consider. Assess the forward, and second is money market hedge, and third is options. So forward rate, money market hedge and options, whichever is the best, where the payment is the lowest, that we have to select. So out of them, obviously forward is the easiest one, so we'll start with forward. Yes, so first of all we have to pay. So import invoice. This is the common thing. How much we have to pay? We have to pay $8 million. So no matter which alternative, but this is what we have to pay. Okay. Fine. So let us take alternative A, forward contract. The easiest calculation. So what is the duration given? 6 months, and 6-month forward rate 84.5. So 6-month forward rate is given $1 is equal to rupees 84.50, and therefore amount payable 8 million into 84.50. So amount payable at maturity rupees 676 million. First option is done. 84.5 into 8. Okay, 84.5 into 8. First answer is done. Okay, easy. Now let us go to the second option. Option B is money market hedge. Earlier we discussed the theory concept of money market hedge. So in money market hedge, what we do is we take advantage of the mismatch in money market rates. Now since we are importer, so importer means we have a liability. So what is the opposite? We create an asset. So I'll just write down the concept. Since we have a liability because we are importer, we create opposite position, that is hedging. We create a opposite position in USA, that is we invest in USA, and invest means we create an asset. That is the meaning of hedge. Right now liability, opposite, asset. So now we have to invest in such a fashion, okay, invest so that the principal plus interest is equal to $8 million. So we are not going to invest 8 million, we are going to invest in such a fashion that principal plus interest will be 8, because later we have to match 8, because if we invest 8, interest will be extra, so again the currency risk will occur. So let the investment be X million dollars. So equation will be principal plus interest. So what is the interest rate in USA? The interest rate in USA is given 3% and 6 months duration. This should be equal to 8 million. Okay, let us check interest rate. Yes, 3% for 6 months now. So if we solve the equation, okay, solving the equation, the value of X comes to $7.8817 million. Solving the equation, okay, this is what we get. So we have to invest there 7.8817. So to invest there, we have to borrow in India. Next step, take a loan in India today at spot rate, so that it is 7.8817. So loan in India is equal to 7.8817 multiplied by the spot rate. So what is the spot rate here in India? Spot rate in India is 83.70. Spot rate is 83.70. So 7.8817 into 83.70. Okay, so the loan in India today will be rupees 659 point roughly 70 million. Okay, after rounding off 659.70, this is the loan. Now this loan we have to repay. So interest on Indian loan. What is the rate in India? Interest rate in India is given as 8%, 6 months. Okay, so 659.7 into 8% into 6 by 12. So interest comes to rupees 26.3839 approximately 39 million rupees, and therefore outflow at maturity. Finally, this is what we have to check. Outflow at maturity is principal 659.7 plus interest. So total we have to pay rupees 686 point approximately 0809 million rupees. And now what happened to our investment there? Okay, what happened to our investment? Our investment in USA plus interest is used to settle import bill, is used to settle import liability. So at maturity there is no conversion. Whole money market hedge purpose is that we don't convert at maturity. Whatever conversion we do it at a spot rate because these rates are known to us. So we remove the uncertainty at maturity, we convert at today's certainty. That's the whole logic of money market hedge. So our answer is 686.09. What was the answer of forward? It was 676. Okay, and now the third alternative. Okay, the third alternative now, options contract. Now let us see what is the answer here. Options contract. Now options contract obviously will have a premium, and because we have to pay, so it will be a call option. Okay, so what the question is saying, call option strike price is 84, premium is 1.2 and 8 million, probability is there. Okay, so let us see how to solve this. Okay, so first is strike price rupees 84. Okay, strike price is rupees 84, and premium, which is obviously supposed to be paid, premium is 1.2. If premium is 1.2, that means, see, whether you exercise the option or let it lapse, the premium is going to be paid. So 8 million into 1.2, so total premium, this is per dollar, so total premium is always going to be paid 8 into 1.2, so 9.6 million. This is always going to be there. This is already paid. So this will always be added. Whether you lapse the option, exercise the option, premium is going to be there. Okay. So now let us see what will happen. Okay, let us see what will happen. Now they have given situation 1. Situation 1 is if expiry price or expiry rate is 82.5. Expiry rate is rupees 82.5 per dollar. And what is our strike price? Strike price is 84. Now if the market is giving us a price of 82.5, why will I pay 84? Okay, why will I pay 84? So in that case, my option will lapse. I will let the option lapse because market is cheaper for me, and therefore I will pay at the market rate, and therefore the payment will be done 8 million into 82.50. 82.5 into 8 million, that is 660 rupees. 660 million I will pay, but along with this the premium is already there. So premium will always be there whether you exercise or you lapse, and therefore your outflow will be 669.60 million. That will be your outflow. Now second possibility is the expiry exchange rate is rupees 86.00. My call option strike price is 84, and if I go and buy in the market I have to pay 86. So why will I pay more in the market? So I will exercise the option, and exercise the option means I have a right to pay at 84, and therefore your payment will be $8 million into strike price now, because market is costlier. So 8 into 84. Okay, 8 into 84. So I have to pay 672. But don't forget the premium. Premium anyhow I have to pay. So premium is 9.6 million. All these are in million. So it is 681.60 million. But now one more information they have given, that these are two possibilities and possibilities have probabilities. So last step is expected outflow. Expected outflow. So situation 1, okay, if the rate is 82, so 669.60. 669.60, but probability is 0.4. Multiply. Possibility 2, 681.60, probability 0.60, multiply. So 681 into 0.6, probabilities are given. So this is 408.96, and 669.6 into 0.4, this is 267.84, and therefore totality expected outflow at maturity is rupees 676.80 million. And now finally we are at the end of the question. So here we have to pay 676.8 in the options contract. In money market hedge we are paying 686, and in the forward contract we are paying 676. And since we are talking about payment, so 676 is the least of all. So conclusion, forward rate is best because lowest cash outflow in case of forward rate. Okay, so here we'll stop our session. I hope you understood the basic concepts. I understood, you must have understood the numericals, how to solve. So we solved options, forward, future, cross rate, hedging, interest rate, premium, discount, everything numerical we have solved. Okay, so all the best again for your examination. I'm your anchor friend, CACS CMA Prasad Bhat. Please do like, subscribe, share, and as we say, knowledge and love, they will increase by sharing. So thank you, and I'll see you with the next revision session.